after report saying, we're going to do it, we're going to do it. Then they did it. No one cares.
An uneventful rate hike from the BOJ. Just baby steps. We'll see what comes next. Under surveillance this morning, commercial real estate in focus.
Commercial real estate is a slow burn. It's a classic burn. In other words, if you go back in the late 80s and early 90s, we had a rolling commercial real estate recession. And so there'll be difficulties, and we're working that. We feel very good. Does that mean banks might fail? There's been thousands of banks have failed across the last 30, 40 years. That's what happens. Business models change. But on the other hand, the quality of the banking system is strong.
It's the latest this morning. Clients of the Bank of America commercial bank soaring as it moves to limit its exposure to CRE, tailoring its commercial lending book to avoid properties most at risk. Joining us now to discuss is Wendy Stewart, the Bank of America Global Commercial Banking President. Wendy, good morning to you.
Good morning, and thank you for having me.
Thank you for having us. I was going to say, thank you for hosting us. You shouldn't be thanking us. Let's talk about your business and how much things have changed. When we talk about commercial real estate, I think we don't narrow it down enough. How much have things changed for this business over the last, say, decade, a shift away from office to industrial? Could you put some numbers on that for us?
So it's definitely shifted. You know, when we think about our business in global commercial banking, it's much more than commercial real estate. That is a part of it, but it is not the only thing that we do. So we work with middle market sized companies, and we define that as companies that generate revenue that is 50 million and growing rapidly to $2 billion. And these companies, some are publicly traded, but a lot of them are privately held. And these companies are companies all around the United States. They're typically third to fourth generation now, and we're working with these companies not only in the United States, but also in Canada and all of their international subsidiaries around the world.
It's related, though, because some of your potential competitors in the past were some of these regional banks, smaller banks, that are constrained with respect to lending because of the commercial real estate loans that are on their books. How much are you gaining share from some of those smaller banks that don't have the same kind of capacity that you do?
So we did have a fantastic year in 2023. It was a story of growth for us. And there was a lot of market disruption across the board that we saw last year. And we did take share as a result of that. You know, I would say lending is not something where we are constrained. We also have a lot of other capabilities that we deliver to clients that really have nothing to do with our balance sheet that our clients want, whether they're digital capabilities, a lot of very unique cash management solutions, the investment we've made in international, the investment we've made in investment banking, and then also the focus that we have on new economy companies, which is something that's relatively new for us over the last couple of years as our economy is changing.
Well, I do wonder if there's sort of an opportunity to go a step further with the weakness that we're seeing in some of the regional banks to acquire whole units to expand. Is that something that's in the potential outlook at all?
You know, for Bank of America, we've been focused on organic growth. Responsible growth has been our mantra for many, many years, and we will continue to focus on responsible growth really through organic growth. And we have all the solutions that we need to be able to deliver for our clients. We just continue to invest, and we're really making investments in our team, so we continue to hire more bankers. And we're making a lot of investment in digital because our clients, they want to be able to bank when they want, where they want. They want it to be fast, safe, secure, and easy. And we've got great solutions to help clients on that front. And I'll give you an example. You know, we have a client recently that a new company we were working with, they were doing business in 13 different countries in Asia. And they were working with a variety of different banks. They were concerned about the exposure that they had. They couldn't manage the risk well. They didn't have a lot of visibility into, you know, just the day-to-day transactions. Plus, they had a lot of currency risk. And so we were able to sit down with them, look at all of their needs, put together a global solution, and they were very happy with that. So we are now their sole provider. So these are the types of ways that we're growing with our clients. And, you know, there's really not an acquisition out there that can help us with that.
Is that a trend? Are you seeing more of that in Asia specifically?
We're seeing a trend all over the globe. And, you know, when you think about US-based companies and Canadian-based companies that we cover, you know, they've historically done business in North America. And they're really looking at taking advantage of the global growth that exists for them. And so, you know, we actually have 3 companies that we cover today, and we're not even through first quarter. And we've got these 3 companies, they're looking to grow. They've never done business internationally. They know that they need to increase their exposure. And so we helped not 1, but 3 different companies, different parts of the United States, different industries, but they all have one goal, and that's to grow internationally. One acquired a company in the UK, one in Italy, one in Australia. We helped all of them. And it's not just about M&A. It's also about the core banking needs that these newly acquired subsidiaries are going to have, and we can help them with all of it.
It's interesting hearing you discuss this, because I would have thought that life for a company is getting harder to go international. Life for multinationals is becoming more difficult because of policies and countries around the world seemingly putting the walls up. Is that not your experience?
So our experience is different. I mean, when you think about a multinational company versus a privately held company that might be in a generation transfer from the third to fourth generation, they have very different considerations. You know, a privately held company, they can think about things over the very long term, where a multinational, you know, they may have different considerations. And so what we're finding is that our companies that we cover want to grow, and we are well positioned to help them with that.
Who are your competitors, your main competitors? Because there's been this discussion around, say, the Apollo or the Ares or the other kind of KKRs of the world trying to eat your lunch.
Right.
Is that the main competitor, or is it the other big banks? Is it everyone?
So we compete with everybody, and some more than others. And so obviously the large banks that you would think of in the U.S. are our big competitors. I mean, we do continue to compete with the regionals. You asked about the regionals. And, you know, as far as private lenders go, we don't compete with private lenders as much. The credit profile of our client is a little bit different than what a private lender would target. And, you know, we've seen really nice loan growth. We saw great loan growth through last year, and we're seeing good loan growth this year.
Do you see the growth, and it's interesting that you mentioned Europe, as stronger there? And do you sort of see cross-border transactions as stronger because the domestic ones are so difficult to actually get approved?
So we see a lot of good opportunity internationally all over the place. So, you know, certainly in EMEA, there's good opportunity. We will continue to invest in banker coverage there. We also look at, and we decide where to invest based on where our clients are doing business. And so we also see Asia as a good opportunity. And we have seen a lot of the reshoring that happened last year back into, you know, Mexico and into LATAM. And that was another good opportunity. So we will, you know, we added bankers there last year to take advantage of that.
I don't want you to tip your toe into the politics, but I have to bring up this question, because we heard from the former president over the weekend that if you're a Chinese EV maker and you're positioning in Mexico, we're going to slap you with a 100% tariff. I do wonder about the future of nearshoring and whether it might be under threat. How do you think about those broader forces?
So, you know, we don't focus as much on the politics. We just focus on the needs of our clients. And so if our clients have decided that that's a good opportunity for them to, you know, move business back into Mexico, as an example, we have bankers on the ground that can support them, and that's absolutely what we're going to do.
Wendy, this was wonderful. It's great to get your perspective on things. Thank you.
Thank you very
much.
much.
After a monster year of growth last year.
Thank you.
Off the back of some difficulties elsewhere. Wendy Stewart there of Bank of America. Not the story we've traditionally heard on the international scene over the last couple of months.
No, but this actually speaks to the idea that there still is trade. It's not that there's been sort of a total protectionist kind of event by companies. People are looking to where the opportunities are, and it is more of a global story. Fascinating to me also to think about, you know, where the lending opportunities are, and that so many people still want to borrow.
Yeah. Next up on Bloomberg Surveillance, the third hour looks a little something like this. The special continues here from Bank of America. We'll catch up with Savita Subramaniam, Jill Kerry-Hall, Michael Gapin, and Lindsay Hans. Got to ask Michael Gapin, the prospect of those median dots maybe making another shift for this year, at least, from 3 to 2. Is that the big risk factor for tomorrow? Is that it?
Dots.
Down to 2?
Really?
Median
Dots?
dot?
Honestly, Claudia summed it up for me. She's like, I'm a dot hater, which I actually...
She's not alone.
She's not alone. A lot of people are saying, why are we doing dots? Why are we sort of connected? What are we doing here? The idea is, are they trapped by their own projections of where the rate cutting cycle will go? Is that a problem at a time when we're talking about, I mean, this is sort of all of us.
In the air. Are we sufficiently restrictive?
Exactly. And so this really, to me, is... I want to see how they message that, given the uncertainty and given that some people are looking to them for certainty at a time where they cannot provide it.
How confident is the chairman of the Federal Reserve? That news conference, just a day away.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera. And I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
The Fed is at the risk of losing confidence. They opened the door for the conversation of rate reductions too soon.
There's more inertia to inflation in a post-COVID economy than the Fed's giving credit for.
Rate cuts are being pushed back for the right reasons, but they're still coming.
The challenge has been everyone's waiting for certainty. I don't think we're going to get it. The Fed is never going to tell us what the path is going to look like.
The Fed would really like a scrap of certainty about what they're going to do later this year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance begins right now from number 1 Bryant Park, Bank of America's home here in Midtown Manhattan. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Your equity market a little bit softer. If I could maybe capture the last 2 hours on this program in a word, bullish. Is bullish the word?
I don't know if it's enough. It's quite bullish. It's bully bull. Like, it's really quite optimistic. And to me, really, the ultimate question is, A, does this really challenge the idea of sufficiently restrictive? And B, can it continue? What's going to drive the next leg if it isn't going to be, say, NVIDIA, which we saw yesterday, somehow that was a dud, even though they announced a chip that would cost twice as much as the current chip.
Well, let's go through this piece by piece and talk about what it could mean for the bond market and go back to the conversation we had with Mark Cabana of Bank of America a little bit earlier this morning. What the bond market is telling you and what the equity market is screaming. This equity market so far this year is screaming really strong nominal GDP. Something Neil Dutter of Renmac talked about just yesterday when we were echoing some of his sentiments. If you look at what's happening in the bond market, we've repriced at the front end, 4.1, to 4.7, just like that in a couple of months. This equity market's done nothing in the face of that. It feels like the stock market so far, at least, and this is not a call of mine, just an observation about where we've been and where we are, seems comfortable with rates repricing higher.
And some people would argue, well, this is the reason why you've seen an underperformance in small caps. This is the reason why you've seen an underperformance in certain utilities or certain areas that are more interest rate sensitive. But the bottom line is, we're not hearing that companies are having trouble borrowing. We're not hearing that that individuals are having issues on their balance sheet with 40% more cash in terms of their savings than they had in 2019. You put this together and it raises this question, what is the pain threshold for rates? Is it 4.5% on the 10-year? Is it 4.75? Is it 5? Is the Fed going to test that at a time where right now it doesn't seem like they can really have conviction that inflation is cooling as much as they'd like?
Can we go back to that stat? I think it's stat of the morning here at BofA. I just find it absolutely amazing. So this is the 6th time I've mentioned these numbers. Median value of savings and checking balances are more than 40% higher from 2019 across all income levels.
And they're not going down materially.
They're stable.
That, to me, is one of the biggest takeaways. We talk about depleting your savings. This was supposed to be happening. It's not. What else did she say? That actually the cash coming into people's balance sheets, the paychecks, even on lower income households, are increasing quite significantly because there's real income gains. You put this together, you start to wonder, where are the cracks? I'm not seeing them.
Policy. I think they're the worries. And policy, maybe not from the monetary policymakers, but from the policymakers elsewhere. When you listen to Brian Moynihan a little bit early this morning, the Bank of America CEO and chairman, if you missed that conversation, go back and have a little look. Pick out the part on mergers and acquisition. We're not seeing less M&A because there's worries about the economy. There's worries about the deal getting done. There's a conversation there whereby a client can't even entertain the prospect of doing the deal, not because they think it's bad business, but because they are worried about being left hung out to dry for 12 months trying to work out whether it's going to be approved, and they don't want to be in that position.
Take that a step further. How much are we living in an era of fiscal dominance and fiscal policy dominance also, just with respect to what's allowed and the money that's gone into balance sheets? How much is the Fed kind of trying to fight against a fiscal dominance that just is all-encompassing? And if that's the era we're in, it has been understated by a lot of people to really fully embrace what that means and how much cash is going into the economy.
Big time. Got to find some time as well to go through this Bank of America Fund Manager Survey, because this is pretty bullish stuff, isn't it? Global growth expectations, 2-year high. Risk appetite, the highest since November 21. EPS optimism, 2-year high. Just optimism, optimism, optimism across the board.
But not euphoria, we heard, so it's all okay.
We're going to hear that word in a moment.
Exactly. So I want to know, what counts as euphoria? Please define euphoria.
We'll get to that conversation in just a moment. Let's start with the price action. Equities negative by 0.4% on the S&P 500. Just a little bit softer in the equity market here, Lisa. You look at the bond market, stable this morning at least, but a big move higher over the last week. We're getting back into the 430s all over again.
Yeah, some of the highs that we've seen of the year, which raises a question, what is that threshold again that becomes a pain point? Because right now, stocks have chugged along despite that, and the only kind of hiccups have come with buy the rumor, sell the news, the leather jacket, the godfather of the AI industry.
Jensen.
Woodstock, AI, blah, blah, blah.
It's the new roll neck, right? It's the new leather jacket.
Yeah, exactly,
Like
it's the new...
NVIDIA has replaced Apple. Yeah.
Black turtleneck.
Yeah.
I like that.
You call it a turtleneck, a roll neck? Whatever. Whatever. Coming up. Is that British? I don't even know anymore. I've been here so long. Okay. Next 60 minutes looks something like this. Savita Subramaniam, Jill Carey-Hall in just a moment on why they think markets and this market rally will broaden beyond big tech. And we'll talk about that word euphoria as well. Mike Gapin and Aditya Bahav looking ahead to tomorrow's Fed decision, and Lindsay Hart of Merrill Wealth Management on why clients are staying mindful of geopolitical risk. We begin with our top story. Tech giants leading stocks higher once again thanks to AI euphoria. Bank of America, Savita Subramaniam, head of U.S. equity strategy, and Jill Carey-Hall, the head of U.S. small and mid-cap strategy, saying this: we raise our S&P 500 year-end price target of 5,400 from 5K, but our bullish conviction has cooled since publishing our 24 outlook in November. We expect the market to broaden beyond the Mag 7 and pockets of the market where we have seen more euphoria. The net message of our market timing framework is still, in one word, up. Savita and Jill join us now for more. Thank you very much for being with us.
Thanks for having us.
Thank
this
you
is
for
very
having
exciting.
us.
I think this is our first time on TV together, so I'm very excited.
Well, let's talk about the constructiveness you both share. And Savita, let's begin with you. That word euphoria.
Yeah.
Where are you seeing euphoria right now?
Look,
and where aren't you seeing it?
I think euphoria is really driven by themes at this point. So it's AI. Everybody owns the AI plays. If you look at positioning, there's a lot of building euphoria around drug discovery, GLP-1. So there's thematic euphoria. But if you look at the actual allocation of fund managers, pension funds are at the lowest level of equity exposure, public equity exposure, that we've seen since the 90s. This is not a market like 99 where everybody is telling you to back up the truck on all equities. They're saying back up the truck on a few equities, mega cap tech, some pharma, but there's no broad spread euphoria in my view. And when you look at the positioning, it says something a little bit different than the survey data, which I think is also important. What they say versus what they do is sometimes very different. I think the risks are sitting outside of the public market. Look at where this credit cycle actually unfolded. It was in private credit, private equity. And I think those are the areas. Regional banks, I think, are still working out some of their problems, and Jill can speak to that as well. But I think that's where you're seeing the credit issues really bubble up.
Jill, let's turn to the banks. How concerned should we be? It feels like we've moved beyond what happened last year. Is that still a focus for you?
Yeah, certainly. I think the regional banks are still an area where I think it makes sense to be very selective. We're positive on small caps this year, but within financials, that's an area where larger banks have looked a bit better than smaller banks, but I think there's still opportunity in some of the regionals. I think this is a market where stock picking makes sense. Our analysts have done a lot of work here. I think the environment this year has gotten a bit more optimistic for banks, given everyone was expecting a recession going into this year, and now we're not expecting a recession. Our economists will talk about that. I think the backdrop for M&A could pick up if we see potentially an easier regulatory environment. We'll see how the election goes, and I think commercial real estate is still an issue, but it makes sense to again be selective, be a stock picker this year, and that's an environment where there's a lot of alpha opportunity.
To Savita's point, Jill, does that mean it's all priced in, all of those credit issues that we basically have heard?
I don't think it's all priced in. I think in pockets of the market, especially when you look at the broader backdrop within, small caps, credit sensitivity, refinancing risk, there's a lot of issues that if rates continue to move higher or stay high, these are areas that are a lot more credit sensitive, and we could see areas like real estate that maybe multiples haven't moved as much. For the overall market, I think for small caps, they have largely priced in some of the credit risks. They were pricing in a recession. They were pricing in, manufacturing recession. They were pricing in tighter credit standards. I think we're in a backdrop where if these continue to ease, then there's a lot more upside in that segment of the market.
Which is the reason why, Savita, it's so fascinating to hear you talk about how it's not a back the truck up kind of moment like it was in 1999 for all stocks, just some stocks.
Some stocks.
But it sounds like you might want to keep backing up the truck in those stocks because they're not as susceptible to rates remaining high. Well, they're not as susceptible to people getting cold feet and realizing that, oh yeah, there is some weakness in certain pockets.
Yeah, no, I think it's fair. And look, I see large caps as safer until we start to see the Fed really cut interest rates. Because where we are now is an environment where we're pricing in, what is it now, three or four rate cut hikes?
2 or 3 now.
3 rate cuts this year. And if we don't get them, I think that's the risk for some of these more credit sensitive areas like real estate, like small caps writ large. I still think there's a lot of smaller companies that are economically sensitive that could do well in this environment. And then the thing I like about the S&P 500 is that a lot of the really risky stuff drifted down in market cap. So you're starting to see the S&P almost get higher quality by attrition since 2022 when the Fed started cutting rates. So if you look at CRE exposure, commercial real estate exposure of the large cap banks, it's a tiny sliver versus where we see it elsewhere. When I think about what you were saying earlier about this policy having given the private sector, consumers and corporates, a long runway of making money on their short duration asset base and locking in long duration liabilities, I think that is what we're seeing in the S&P 500, in the average US consumer, and those are the areas where I think we can press this, because even if the Fed doesn't cut interest rates, there's still, relative health and relative gains in those cohorts.
That's what I wanted to get into. Why do you think we have been so comfortable with this repricing of interest rates higher? Why do you think we've been so comfortable with hot CPI prints, hot PPI prints? Last week, CPI came in hot. The equity market rallied.
Yes.
What's that about?
Well, the S&P rallied, and parts of the S&P rallied because I think that the S&P 500 is now, a different animal than what it was in 2007. Half of it is asset light. It's got positive net cash in the biggest sectors of tech. So I think it's a very different credit cycle. And this is what we need to pay attention to is where has credit been extended, who borrowed, and who's going to be hurt by a rising interest rate cycle. We're starting to see that, but I think that's what unfolds over the next few years.
Leadership has been narrow. I think we can all agree on that, particularly last year. You make the point, Jill, and I think it's a point worth exploring, that small caps tend to outperform following periods of narrow leadership. What is that about? Is that connected to the cycle? What is that trend?
Well, I think, we've seen it both small caps tend to outperform and as Savita, and we expect, the equal weighted S&P 500, we see opportunities there as well. I think, we're in an environment where the market was led by these very narrow themes, some of these mega cap growth stocks. And now you're at a point where positioning is starting to turn more positive on economically sensitive themes. We've seen inflows into small caps for the last several months, but positioning is very light. A lot of these things run in cycles. So small versus large cap leadership, these longer cycles tend to last about 10 years. Investors were in a period from 2013 to 2020 when small caps underperformed, and now the average multi-cap manager is about 40% underweight small caps in their portfolio. So, I think this is a point where you're starting to see more interest in the theme. The economic data, some of the macro indicators that Candace talked about earlier are all turning off the bottom, so that tends to be a positive environment for some of these areas of the market that your average fund manager is underexposed to, like small caps, like cyclicals.
It sounds pretty bullish. I mean, yes, there's some risks if the Fed does keep rates here.
I think it's meant to sound bullish. I think that's the objective.
I guess here's my question. It's not necessarily the same kind of conviction that you used to have. Why?
Well, I can answer that. I think for me, it's because there is more high conviction bullishness on equities. Like I said, not all equities, but pockets. And I think those are the areas you want to watch. I mean, how much do these AI plays have to beat earnings from here in order to continue to go up? So that's where I worry. And I really firmly believe we could see a correction in those areas of the market. We could see a 5% pullback in the S&P, which has been, the straight up benchmark for the last, almost 20 years now. But I think that those are the risks. I think outside of these themes, there's a lot of, dry powder for real growth. And when you listen to the Institute, when you listen to Candace talk about the indicators we all track, it sounds like this is more of a GDP story rather than just an earnings story.
Which raises this question, in a GDP story, don't bigger companies have an advantage structurally at a time where if they can invest in technology and they can invest in some of these small near-term investments, even as they lock in their longer-term obligations, Jill, ultimately don't you get smaller companies fundamentally disadvantaged in a new way that's different from in the past?
Well, I think while there's some of that, I also think that if we're in a CapEx cycle, a lot of the domestic smaller companies are the ones that benefit if, a large mega cap is spending. The domestic SMID cap, especially if some of these companies are reshoring, bringing back manufacturing to the U.S., I think that's a longer term theme that'll benefit some of these cyclical domestic smaller companies within the U.S.
Final question, Savita. We often do this. I always ask you this. Biggest risk, still upside risk?
To the S&P?
Yeah.
Yeah, I would say so.
Savita, great to see you. Jill, thank you to both of you. I can't believe you've never done this together before.
I know.
But it worked beautifully.
Yeah,
thank
thanks
you.
for coming.
Thank you very much. Thanks for having us. Up next on this program, NVIDIA looking to extend its AI dominance.
The industry is being transformed, not just ours. Because the computer industry, the computer is the single most important instrument of society today.
That conversation up next, live from New York City. This is Bloomberg.
Britain's next.
It was going to keep reading World Cup. This is a 3.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Live from New York, be up in about 1 hour and about 12 minutes away. Your stock market looks like this on the S&P 500. Equity futures through most of this morning negative, still down by 0.5%. Yields just about unchanged. 10-year, 4.3223. Under surveillance this morning, NVIDIA looking to extend its AI dominance.
The industry is being transformed, not just ours. Because the computer industry, the computer is the single most important instrument of society today. Fundamental transformations in computing affects every industry.
Here's the latest this morning. NVIDIA unveiling a new AI processor design called Blackwell. The CEO promising it will be industry-changing technology. Alkesh Shah of Bank of America Global Research weighing in on the AI craze, writing, quote, "It represents a paradigm shift in line with past disruptive technologies. However, significant economic implications do not necessarily indicate immediate top and bottom line growth for the enterprise software companies producing AI products." Alkesh, I'm pleased to say, joins us around the table. Alkesh, good morning to you, sir.
Good morning.
Thanks for having us. So I'm going to go full doomsday, sort of end of history type stuff. We all end up on UBI, the end of aspiration, incredibly depressing. Where is this going? Is it going to be capitalism eating itself, or does it end up being something much better than the world I've just described?
Sure. So, well, first, thanks for including me.
You don't have to thank me for that.
I was about to say. Good morning.
So if we take a step back, really the way we're looking at how AI changes virtually everything we do is it's probably the third transformational wave that we're experiencing. The first one was actually the microprocessor in the 70s. So what that did was it democratized access to computing power, right? Everybody got a PC, they have a notebook, you now have a smartphone. Then in the 90s, you democratized access through the internet browser to information. So in the 70s, democratized access to computing power. In the 90s, democratized access to information. And even though AI is about 70 years old, really the Gen AI technology has democratized access to intelligence. So that's the real change. So now that you have access that only data scientists and quants used to have, you actually can use intelligence straight from your smartphone, leveraging all of those waves. And that's why we think, really, we're only in 1995 of this build out. So, you know, as somebody who covered parts of the internet back in the 90s, I've watched those cycles, and there are definite parallels with the build out. And we're only 15 months into this build out, as my colleague Vivek, who covers NVIDIA, has talked about. And it will be years, because there are different stages for that.
So we've got to identify winners at different stages. And as you know, through the internet, if it's 95, identifying who the ultimate winners would be in that period was actually difficult. So you just bought everything. And a lot of people bought the wrong things. What do you do now? What's the best approach? How do you think about who wins each stage of each cycle?
Sure. So if you think about the stack of technology for AI, the first thing that you have to do is you actually have to build these models so that you can leverage the AI having applications on top. So that's what you're seeing right now. You're seeing the chips, the servers, those are being bought and those are being deployed. And at this point, the models are still growing. So that build out is still happening because the applications that we want to use on top of them aren't where we want yet, right? The average intelligence is probably of a 15-year-old intern. And, you know, it's great to have an infinite number of 15-year-old interns, but but you definitely, you know, want something more intelligent over time. So you still need more processing power. You need to upgrade those models. And those models, though, are benefiting the chip companies, the server companies, as my colleagues Vivek and Wamsi talked about, but also the public cloud companies where those models are sitting, right? And so that's why we like Microsoft. That's why my colleague who covers the internet likes Amazon, likes Alphabet, because those guys are benefiting because they're actually hosting those models. And that's very different from the internet, right? Because in the 90s, the internet was built using debt, right? All of those telecom companies raised all of this debt. And the companies that were doing applications on top of that had no monetization models. When that stopped, those companies went bankrupt. What's different here is these models are being built out of cash flow of the public companies, not debt, and the private companies are using equity.
I love this. John asks, are we facing the end of times? You say we've democratized access to intelligence. I mean, this is basically where we're at. Here, I just want to know, to put a bow on all of this, there is a belief that some of the broadening out in the equity rally is going to stem from productivity gains tied to artificial intelligence. Are you essentially saying it is too soon? It is going to take years before we see it percolating out to the rest of industries? Or are you possibly seeing the democratized access to intelligence making our world better?
I think over time it will make our world better. I think the expectations were that things would get better immediately, which it will take time, right? Because what has to happen is corporate adoption needs to take a deliberate approach because they have to understand the models. If you're a regulated industry, you have to explain the biases within the models before you can really use them, before you can roll them out. So it will take a few years, but what we did was, we have the #1 research team on the street. I surveyed our analysts to figure out exactly what they thought their sector would benefit from AI over the next 3 years. And on average, we expect a 250 basis point operating margin improvement, which is $65 billion annualized savings for the S&P 500, over $100 billion of savings a year.
Wow.
Globally. And that could be conservative because that was a survey that was done a few months ago without all of the applications that are coming out now. So we definitely see it hitting over the next 3 years. So it won't be a straight line up, but we definitely see the line moving up.
This is far less depressing than my commentary, Alkesh, you realize that. Look, the way I think about it, and it's problematic, is that better for who is how I'm thinking about it. You know, Brian sat in your seat just a moment ago and we were talking about how less labor intensive each additional dollar of revenue is. Now, if that's the same for all these companies that adopt this technology, it's going to be a lot of people without jobs, Lisa.
Well, and take it a step further, the people that they do have are paid a lot more because the actual workers who are able to meet the challenge at hand, who are smarter than a 15-year-old intern, are able to get paid accordingly while other people are going to struggle to be employed. I mean, that's sort of the dichotomy that we're talking about.
I'm going to give you a call because we need to have a longer conversation. Super smart. Thank you, sir.
Yep,
Alkesh Shah there on AI, beyond just sort of the depressing end of history type stuff. And,
You're the only one pushing that. Actually,
I don't think I'm alone. I got a lot of people reach out to me
A lot of
today
people, I would agree.
who share that
Some
concern.
family members.
Yeah. Ready?
Mm-hmm.
Yeah. Oh, yeah. I know you told me. Coming up, breaking housing data and building permits. Bank of America's Mike Gapin and Aditya Bahaf here to react and give their outlook for the economy and the Federal Reserve tomorrow.
names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
The last slate of economic data going into the Federal Reserve tomorrow. Some housing starts and building permits coming up in just a moment. Mike McKee's going to break them down for you. Let's start with some price action going into that. Equity futures on the S&P, on the NASDAQ, on a Russell. We're negative across the board. Those losses are building up in the last 10, 15 minutes or so. We're negative 0.5% on the S&P, down 0.8 on the NASDAQ. In the bond market, switch up the board, a 2-year yield higher over the last week or so, 472, a little bit lower this morning, down a basis point at the front end of the curve. With that economic data, let's cross over to Mike McKee. Morning, Mike.
Good morning, John. Well, we were expecting a rebound in housing starts, and we definitely got one. Weather improves in February, and so do the number of holes in the ground. 10.7% increase to a 1,521,000 annual rate for housing starts. Building permits also up significantly, 1.9% to 1,518,000. That's from a decline of 0.3 the prior month. So it looks like home builders are gearing up for the spring selling season. This is one of those interesting numbers that we expect to keep going up because there's not enough houses for sale. So it's not so much that, it's when do we get more housing for sale from the existing home markets. I know you've got some smarter economists than I there that you can talk to about it, because it's all a question of interest rates at this point.
Well, Mike, it's sort of an upside-down world. Rates have gone up to 5.5%, but supply's been constrained and prices have gone higher. Mike, can you make sense of some of this for us?
Well, that's one of the problems that the Fed faces, is that normally they would affect housing. They would bring housing down, and people would sit and wait, and then when they cut rates, people would go out and buy houses again, and then prices would rise. In this case, because so many people locked into very low rates, prices are rising because there's nothing on the market to buy, and the Fed is not being able to have the same kind of influence it has on interest rate sensitive sector of the economy, the biggest one.
Mike, I'm really struck by the fact that, yes, we did see a rebound, but it was even bigger than people had previously expected, right? And this has been sort of the theme that we keep getting, that instead of being 1.4 million, it was 1.52 million. I'm just wondering, when you take a look at this, what that suggests to you about how economists continue to underball or lowball some of the growth and some of the desire to keep building and expanding.
Well, it all depends on what numbers you look at. The ISM numbers, for example, suggest that we're seeing some manufacturing business slow down. The thing about housing is there is a big built-in demand. A lot of people want to buy houses, and there's not enough houses for sale. What these numbers may suggest is that the supply chains for building materials have gotten a lot better, and that builders are able to find workers, construction workers, to follow through on their building permits. So this is one category, the new home construction area, where things have been a little bit better than have been expected.
Hey, Mike, we've got to leave it there. Looking ahead to the Federal Reserve, Mike McKee, and the latest economic data. Equity futures on the S&P, we're about an hour out from the opening bell. We're negative here by 0.5%. Joining us around the table, Michael Gapin, the Bank of America Global Research Head of US Economics, alongside his colleague, Aditya Bahaf, Senior US Economist. Mike, Aditya, great to see you both.
Thanks for coming to One Bryant Park.
Thank you very much for having us. Thank you once again. Before we get to the Federal Reserve, can we just talk about the recent economic data? And can you point to something that demonstrates we are sufficiently restrictive at the Federal Reserve?
It's tough. I mean, as Mike was just saying, housing is your typical suspect, and it's hard to... Housing did react. Activity did slow down, but maybe not for the reasons one would expect. I think you could point to bank loan growth as another area that's responded to higher rates, but outside of maybe loan growth and housing, it's difficult, in my view, to find sectors of the economy that had obvious interest rate effects.
Aditya, are the long and variable lags just super, super long, or are we just not tight enough?
Well, we are starting to see some impact on retail sales as well. The last couple of prints have been soft, and then what was more notable for me was the downward revisions. So after those revisions, it really looks like about 4 of the last 5 months on retail sales were somewhat weak. So we're seeing some moderation there. So far, it's being offset by very strong services consumption, but we'll have to see if that continues.
All right, I have to say, we've spoken to one person after another. Everyone's been bullish this morning. Looking at the consumer, yeah, retail sales might have been a little bit softer, but for the most part, right, it was, cash really good. Then the economists come in, and you guys say, well, there's a little bit of weakness. Is that enough, Aditya, that sort of we had one bad retail sales print, that otherwise people are being more discretionary? Does that really suggest we're sufficiently restrictive?
It's a good question. I think it's, as Mike said, it's tough. It's a question of supply and demand, right? What we experienced in 2023 was a very broad supply shock from the labor market, from supply chains healing. And just by definition, when you get a positive supply shock, you're going to get above trend growth and disinflation at the same time, right? The question is, where do we stand on that? And if those supply shocks go away, then I think we'll get a clearer picture of what's happening with demand under the hood. Some of the work we've done suggests that demand is cooling off a little bit, but there's more ways to go.
Is this enough, Mike, to give the Fed confidence that there's some kind of true disinflationary trend other than just year-over-year comps that were nice for a couple of months?
Yeah, I think that the premise to your question, I think, is saying is, does the Fed actually need to do more to bring inflation down, or is supply enough, right? So in other words, do we need restrictive policy to get sustainably to 2%? Because I think most people would say policy is moderately restrictive. It's doing something, but there's a question how much. But they're complementing that by saying, well, we're getting this helpful boost in supply, and that's also what's bringing inflation down. The combination of the two, I think, gives them confidence about the overall disinflation trend. So rates at some point should move lower. The lack of confidence is about when does the window open, when does the data tell them, okay, it's fine to start. So I think there's a little uncertainty about when to start, but I think the confidence in the overall disinflation trend is there.
So your call now is June. So let's talk about June. What is special about June, apart from the fact it's not March? What is special about that month? Why is that the month now for so many people on Wall Street?
I'd say 2 reasons. The data aligns a little better in June in terms of year-on-year rates of inflation being, we think, at subjective levels that they might like. Are they about to move the
goalpost here, though, Mike? Are they going to focus on year-over-year and not the month-over-month surprises?
Year-over-year is kind of, they've said we had a good 6-month run, we need more evidence. So I think that's kind of shifted us all to looking more a little to year-on-year. The other reason I would say June as opposed to May or July is that if you think you're cutting rates every other meeting once you start, I think you want to align those policy decisions on meetings where you release new projections. So I think that puts all of us on June as opposed to, say, May or July.
Let's build on that word confidence. The chairman talked about needing more confidence. Do you think, based on the evidence that we've seen, the data we've had between the last meeting and the one we're about to see tomorrow, that this chairman has lost, gained, or retained confidence?
I would say less confidence around the timing, but still confidence on the overall disinflationary trend.
You could sense, Aditya, in that news conference the last time around, he wasn't quite comfortable talking about the overall disinflationary trend. Yep. And he wanted to know whether any of it was due to one-off factors. When you look at the trend for goods inflation, do you think maybe that worry is justified?
So we got 1 month of goods inflation after several months of outright deflation, so I wouldn't say that's a concern yet. There's a couple of things, if you want to be concerned, that you could be concerned about. One of them is... Okay, well then let's give you something to be concerned about, right? One of the things is there was this question, if you just do it from a bottom-up perspective, about whether goods deflation would end or slow down before housing started to cool off. And it looks like that might be the case. Again, it's 1 month of data, you don't want to take it too seriously, but that suggests that you could get stuck above 2% for a longer period of time. That being said, the other concern out of the January report was that there was this big jump in services ex housing, right? Would that continue, or was that a one-off? And that actually looks like it was more of a one-off.
There is also this question that we keep raising again and again. Are financial conditions contributing to a prolonged inflation, kind of sticking in the economy? And Michael, I'd ask this of you. Do you think it's important for the Fed to push back a little bit and say, yeah, if things get this easy, if anyone can borrow, if stock markets are doing great, if you see mortgages start to come back to the fore, if you just get a 0.5 percentage point drop in the rate, do they need to do that to kind of bring this sort of a little bit more in check?
I think they need to keep financial conditions restrictive. I do. I think things rallied too much from their perspective from the October-November period to earlier this year. I think they know if we're going to start an easing cycle at some point, financial conditions are going to ease, right? So they can't, have their cake and eat it too. But I do think they need to keep financial conditions restrictive on average. And I think they are. I think by our proprietary indicators, they're restrictive, but they're not as restrictive as they were in prior cycle peaks. But again, if they're getting a supply side rebound, that should be enough. But I think to your point, they would want to lean against, in their mind, whatever is excessive easing in financial conditions.
Aditya, how is this restrictive?
That's a good question.
You get all the hard questions.
Right, right. So what I would say is the Fed would be way more concerned if the markets aren't pricing an amount of cuts that the Fed views as appropriate, right? That was the case earlier this year, at the start of the year, when the markets were pricing 6.5 cuts, and that was clearly not what the Fed had in mind. Once the market's pricing a sort of reasonable number of cuts, let's say 3 this year, or 2.5, then whatever that implies for equities, spreads, I don't think they want to get involved in that, right? They don't want to be in the business of managing risk premium. So I think they're reasonably comfortable now. They probably weren't at the start of the year, which is why the pushback was a lot more aggressive at the start of the year.
Let's finish on the playbook for tomorrow. So statement, projections, news conference. Let's go to the second point, projections. Only takes a few policymakers to come up just a little bit. That median drop's going from 3 to 2. Aditya, is that what you're expecting tomorrow?
No, we're expecting them to stay at 3 cuts, the median 2, but it's a very close call. As you said, it only takes 2 people to move up in order for the Fed to go from 3 to 2 cuts. The question is, do you really want to signal that? What are the implications of that? Just to add to a point that Mike was making earlier, if you can't justify a cut by June, given that the base effects will be a lot less favorable for the rest of the year, you might not have a leg to stand on to start cutting until early next year. So that might be a reason to just get going now unless you're really comfortable starting next March, right? So for all of those reasons, we think it stays at 3, but it's going to be a very close call, and that's going to be the big focus for markets.
Mike, what would you look for?
So we're on the same page for that. But yeah, it's a close call. I think you're going to get a big upward revision in growth, something maybe to around 1.8 this year. We think PCE inflation on a core basis gets revised to 2.5, 2.6. We're at 2.6. We think there's enough time between now and June for them to say, let's look at the data a little bit more and not prejudge it. But yeah, it's a close call.
Can I just say, they don't care about spreads and micromanaging them when they're doing well, but they care when they're doing badly. So it raises this question, ultimately, we're talking about a Fed put all over again,
Do you want them to be consistent? Is that what you're asking for?
I'm just looking for some sort of
I think we're trying to figure out how symmetrical this actually is right now.
Thank you.
I think there is a belief in the market, there is an asymmetric stance at the Federal Reserve that if growth is strong, they won't respond to it with hikes. If it's weak, they can cut. I think what we're trying to figure out, at least from myself over the last week or so, with hotter than expected inflation prints, whether that tempers their ability to retain that option of just saying, we'll cut if the economy weakens, we won't hike if it gets stronger.
Right, and I would add on top of that asymmetry, remember in average inflation targeting, you're only responding to shortfalls of employment from its maximum level. So another reason to kind of ignore what's happening on the activity side.
And just on that subject, we get asked a bit about the downside risk, right? And I think the big downside risk is probably if you can't cut this year, you get to next year, inflation's still sticky, things slow down and you don't have the Fed put, right? So we've been so reliant on the Fed put that the big downside risk to the economy is if that goes away, things could get sticky.
So in what sense would it be in conflict?
In conflict, if inflation was still above target, but unemployment started rising and it threatened maximum employment.
Ultimately, I think they'd respond to the activity side, because I think you would assume inflation with a lag would ultimately respond to that economic
Would that be the right assumption?
Yes, I think so.
Okay.
Yeah.
Mike, appreciate it. Michael Gapin.
Kind of a weak last word there, but thank you.
No. Don't worry. The conversation will continue from Bank of America to the two of you. Thank
you.
Looking for that median dot to maybe stay at 3 with a threat, Lisa, of dropping to 2. And it wouldn't take much for it to go from 3 to 2 tomorrow.
It just raises this interesting question, is inflation a lagging indicator? And is sort of the jobs market a leading indicator? And is that really how they're going to respond? Or are we looking at sort of an implicit 3% target rather than 2?
I think the meeting tomorrow is a little bit more interesting than it was maybe a month or so ago.
I would agree.
That's what I'm going with.
We're going to talk that up.
Let's get you an update on stories elsewhere this morning. Is that marketing? Is that what it is? Promo for tomorrow's special. Let's get you the Bloomberg Brief with Shonali Basak. Hey, Shonali.
Hey, John. Hong Kong has a fast-track measure further cementing China's control over the global financial hub. The approval of Article 23 completes a 2-decade campaign to pass local legislation protecting the Chinese state. New crimes such as treason and insurrection carry life sentences, and the measure also broadly defines state-secret offenses in line with China's vague legislation around espionage. The move raises questions over the city's status as an investment and tourist destination. And Bitcoin continues its slide from an all-time high after record daily outflow from the world's biggest ETF for the token. The $25 billion Grayscale Bitcoin Trust posted a $643 million outflow just yesterday, the most since the ETF began trading on January 11th. ETFs overall have attracted a net $12 billion, which helped propel Bitcoin to a peak of nearly $74,000. Philippines President Ferdinand Marcos Jr. said the threat to his nation from China's sweeping claims in the South China Sea is growing, but argued that his government's effort to assert sovereignty over disputed areas are not meant to start a conflict by poking the bear. Marcos spoke exclusively with Bloomberg's Haslinda Amin a few hours before the U.S. Secretary of State Antony Blinken.
It does not serve any purpose to heighten tensions. That is precisely what we want to avoid. This is not the poking the bear, as it were. We are trying to do quite the opposite. Yeah.
And that's your Bloomberg Brief, John.
Hey, Shonali, appreciate it. Thank you. Up next on this program, the recession that never arrived.
Everybody's trying to really figure out how this economy will perform. And, 4 months ago, people were worried about a recession. 6 months ago, worried about a recession. Now they're not.
That conversation up next, live from New York City. This is Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, time right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is Bloomberg.
The opening about 42 minutes away. Here's the state of play, the scores, if you will, on the S&P 500. Equity futures negative through most of this morning. A little bit negative now by 0.4% on the S&P 500. Unlike the last week or so, yields a little bit lower on the session, on the week, a whole lot higher. 431 on a 10-year at the moment. Dollar strength has been a theme in G10 over the last 24 hours against the euro and the Japanese yen. Lisa, euro dollar 108.55.
Really, it's going to be the emphasis on Jay Powell and whether he comes out with a bit of a hawkish tone. Does he push back against some of the enthusiasm we've seen in markets? Are there 2 DATs rather than 3? This, to me, is going to be the main macro driver when it comes to FX potential volatility, which this year has not been great.
And the enthusiasm, by the way, enthusiasm in this building over the last 3 hours. The constructive tone at Bank of America is pretty phenomenal, isn't it?
The stats that we've hooked onto, right? Not only the fund manager survey showing that enthusiasm, the cash, you can repeat it for a 7th time, 40%, more than 40% increase.
That's insane.
In the cash and savings that people have on their balance sheets. It's not going down. So why are people feeling like the consumer is running out of steam? But it doesn't look like that when you look at the back.
This economy has been a whole lot stronger than many people expected. Under surveillance this morning, the recession that never arrived.
Everybody's trying to really figure out how this economy will perform. And 4 months ago, people were worried about a recession. 6 months ago, worried about a recession. Now they're not. But now the question is, do they really want to invest heavily in it? And that's where you're seeing the little bit of tension here. So everything's fine, solid, resilient, all the words you wanted to. But it has to sort of work the next twist in the economy to get back to normal.
Here's the latest this morning. The Fed's 2-day meeting beginning today as the committee prepares its latest summary of economic projections. Bank of America's Merrill Wealth Management saying clients are, quote, feeling optimistic, but investors are mindful of geopolitical risks as they continue to keep a close eye on Fed announcements and anticipate some choppiness throughout the year. Joining us now, I'm pleased to say, Lindsay Hans, the president and co-head of Merrill Wealth Management. Lindsay, good to see you.
Great to be here. Thank you for having us.
Thank you for having us.
Yeah.
Let's start with these numbers coming out of your side of the business. 2023, you added a record 37K net new clients. That's up 50% versus the prior year. Where has that business come from?
Yeah, it's a great question. We've seen tremendous interest in clients working with financial advisors. We chalk that up to a couple things, John. We look at the pace of wealth creation in this country, which is accelerating. It's really doubled when you look at U.S. household financial assets for wealth management in the last 10 years. We don't see that slowing down. You see the wealth transfer, the great wealth transfer. It's not going to happen. It's happening now. And the world's becoming more complex, not less. So all that backdrop really leads to more and more clients realizing the value and the need for professional financial advice delivered by a human being. That's our FAs, that's our financial advisors.
Yeah, the human being aspect of that's important. We might return to that a little bit later in the conversation. Can you talk to us about the nature of that money? Where's that money gone? Is it just sort of cash funds? People sitting there in money market funds taking 5% and sleeping well at night? What is it?
Good question. We've seen a shift. Prior to the fourth quarter of last year, we did see our cash balances really grow, really to a level that was 3 times prior to the current rate hike cycle. We started in the fourth quarter seeing that cash move off the sidelines. Where is it going? It's going into a couple different places. You see it moving into equities and fixed income. Our clients tend to move into our professionally managed portfolios, either by Chris Heisey and our CIO team, or all the separately managed accounts we offer on our platform to clients. So you see it going into equities. You see clients last year, especially in the back half of the year, lock in yields. We saw a lot of bond ladders. And then you're seeing alternative like investments as well. So we're seeing clients, and it's got to be a certain type of client, but you're seeing clients wanting access to private markets as well as public. And our AI assets have doubled in the past 5 years.
I just am wondering, just going back to where is the money coming from, is it all the same households that are just building their wealth and then able to come to you? Or is this actually a broadening net where people are earning more and able to invest a greater proportion of their assets?
I think it's both. You know, there is a lot of wealth creation that still is happening. Businesses are continuing to be sold. Liquidity is being generated. Wealth is being transferred between generations. You look at baby boomers, which control half of the wealth. That's ages 59 to 77. That's an age demographic where money's not going to transfer. It's starting to transfer. It already is. So you're seeing all the above. And those are all the clients that we can serve.
The reason why I ask this is because I think about sort of this idea that consumers have locked in benchmark rates if they have mortgages, if they already have bought a house. They aren't paying that much more in interest, but they're earning much more, not only in interest from even short-term instruments, but also from an equity market that's doing just fine. So this is where it comes from, that easy financial conditions, that basically these are consumers that have much more spending capacity. How much is that sort of possible to continue? How much do you see that as like sort of something that has legs?
Listen, we still see a tremendous amount of cash on the sidelines. I think that's come up here earlier in the program. So that money is going to get put to work. You know, we look at that money, you know, like I said, as of the fourth quarter, we see that money moving into our fee-based platforms at a really high rate. We're on pace to well exceed last year what we saw. And look, it's really client by client. So in our business and wealth management, no client is created equal. Our financial advisors work with our clients, figure out liquidity needs, how much money do they have to have on the sidelines, how much money do they really should they put to work, what's their risk tolerance, their time horizon, their comfort level with risk, what are their growth projections, and all that is done in a financial planning context. And most of our clients are asset allocated. Most of our clients have a well-diversified portfolio across equities, fixed income, some alternatives as well, and then cash has become an asset class again. So, you know, there is a piece of your day-to-day operating cash, and there often is a piece where if we've got a little money, we can wait, we can earn pretty decent yields.
We've got about 30, 40 seconds left. You talked about adding people.
Yeah.
Music to our ears, not sort of robots and AI and tech, people. How important is that to you?
Yeah, 65 trillion is what we estimate U.S. wealth management assets. This is a business that is, we believe, best led by human beings. So you need more advisors to go up against that marketplace to complement the existing FAs we have today. And before you let me go, it's Women's History Month, so I'd be remiss if I didn't acknowledge that opportunity both for our terrific women financial advisors that are here, that lead the industry, as well as talent that should absolutely come into this profession. We need more women to come here and like face off against the market.
Led by you, and thank you very much for your time today.
Thank you for having us.
Thank you.
And on behalf of all of our colleagues, thank you for being here. We're so happy to host you, and we hope you come back.
Well, thank you. If you'll have us, we'll do
Yes, we will. I'm not sure about everybody over here. We'll love the noise interruption.
I don't know if they want us back.
Yeah, but thank you so much.
Lindsay, thank you. Lindsay Hunt of Merrill Wealth Management. Just a programming note for tomorrow. Tomorrow, of course, Federal Reserve Decision Day. We'll be catching up with Francis Donald of Manulife, Wei Lee of BlackRock, Steve Major of HSBC, Jan Hatzius of Goldman Sachs. Let's finish with this, Bramo. A special thank you to the whole team at Bank of America at One Bryant Park.
And all of their incredible bullishness to kick off Fed meeting.
Does that make you uncomfortable?
Of course it does, but come on. But no, we're basking in bullish.
Live from New York City, for our audience worldwide, this was Bloomberg Surveillance.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
things like solar or wind, it's nice and environmentally friendly, but really it's not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
From New York City, for our viewers worldwide, a very good morning. I'm Manus Rennie in for Jonathan Farrow. These equity markets are selling the facts all the way around. The Woodstock of AI has NVIDIA lower this morning. It's just a hint of a lack of belief in tech. Can it carry through to the upper ground? Countdown to the open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up in the show, futures move lower as the central bank extravaganza gets underway. The Bank of Japan puts an end to negative rates with the focus turning now to the Fed. And NVIDIA shares under pressure, as I said. The AI Woodstock delivers few surprises. We begin with the big issue, global central banks getting to work.
It does feel like we are now in a new era, and maybe this time is different for Japan, and also when it comes to investing in the economy's markets as well. The meeting in and of just by itself isn't quite a game changer in the sense that, one, it was very well telegraphed, which I think is flowing through into some of the market moves that we're seeing. And also, even though we've seen that rate hike, we are seeing a lot of accommodative leanings within some of the other details.
It is a host of monetary policy decisions still to come this week, including the Fed tomorrow. Let's get our team coverage underway. Enda Karen and Michael McKee join me. Enda, to you first of all. The Bank of Japan ripped off the Band-Aid. They've thrown off YCC, and they've raised rates for the first time in 17 years. So this is a significant move, but the markets are not reacting to the scale of the move, are they?
No, they're not. It was a 7-2 vote. I think the big takeaway was that the Bank of Japan, weren't necessarily in a hurry to signal another rate anytime soon. They were careful in the language. Governor Ueda made the point that overall policy settings are still supporting the economy, so he wasn't signaling any kind of a rate hiking cycle like we've seen in Europe or the US. He did say, though, that if wage gains do continue, they're going to keep a close eye on that, hinting perhaps that the Fed or the BOJ does have some options up its sleeve to maybe tighten again later in the year. But I think all told, the BOJ will be happy with the outcome. The yen coming off a touch is nice for their exporters. They didn't want to set the yen on fire, of course, which would have caused more pain for the economy. So they've pulled out of ETF buying. They've pulled out of negative rate theory. They've scrapped the YCC without blowing up the markets. I'd say the BOJ are probably feeling confident that it's a job well done, at least for this part of their policy program.
Yep, certainly the markets have reacted judiciously for now. And thank you very much. Mike McKee joins me. We are in the middle of the conversation conversations about what comes from the Fed. And of course, the market has begun to reprice. It's now toying costs for a rate, let's say, moving from 3 to 2 cuts beginning in June. Mike.
Well, I wish I could promise as much excitement as Enda got with the Bank of Japan, but the Fed may not provide it. There is a question about whether they would change the dot plot, but the general expectation is they stay with 3 rate cuts this year, because if they don't, it will send quite a signal to the markets, and we wouldn't have the kind of reaction that we've had from the Japanese markets. There is also widespread belief that they're going to raise their inflation forecasts. They will have a discussion, but no decision on when and how they're going to start tapering their balance sheet QT. What you don't expect from them, of course, is a rate move. They're not going to do that this time. And they're not going to give us any guidance on rate timing, which is what really would make people on Wall Street happy. The interesting debate, which we probably won't find out more about until either the news conference or maybe the minutes, is do they think the bigger risk is a slowdown in the economy or sticky inflation? The economy has started to show signs of slowing. The city surprise index heading downhill, not suggesting that there's a lot of residual strength here yet. And then when you take a look at inflation measures, there's been a big surprise over the last 2 months. We have seen inflation, CPI, PPI, PCE, all rising the past 2 months. Does that indicate that there is something wrong with what the Fed is doing, or are these areas that the Fed doesn't seem to be able to touch with their monetary policy? That's going to be a question for Jay Powell as well. So a lot to think about, and we don't know whether we'll get any kind of market surprise or not.
Okay, let's see where those dots go. I think that's where the real focus is. And thank you very much, Enda Karen, Mike McKee, for the update. Kit Jukes wrote this morning after the Bank of Japan. Deflation is over, real wages are rising, and maybe the equity market appreciates the long-term implications in a way that the FX market does not. So let's pursue that conversation. We've got Ethan Devitt of Moneta and Vishy Tripatur with me from Morgan Stanley. Good to have you with us. Let's just kick off with the Bank of Japan, because they seem to have sort of driven by this market unscathed at the moment. Would you agree, Ethan, that this has been a sort of a move where the FX market has just shrugged its shoulders, it's sold the fact, so to speak, but the equity markets are still quite optimistic in Japan?
The land of the rising sun is really only rising right now. There has been such extraordinary strength in that market, a lot of it quite divorced from fundamentals. When you look at the average age, there are some of the demographic challenges, and really some of the hope that's built into this so-called better, more friendly shareholder environment there. So there is a lot of head scratching, I think, around the strength in Japan. No surprise that they did skate by this rate move, as it was long forecast, and in fact very modest and very much a sign of health. And again, with the weaker yen, that is, of course, another source of strength for the economy there. So I'd say no real surprise. What is a bit of a surprise is, I think, how resilient the equity market has been. That is extremely frothy, these 40-year highs. Again, why isn't this being affected by the same fundamentals that seem to be affecting China for similar reasons?
Yeah, I mean, as you say, it's perhaps divorced from fundamentals. It's reminiscent of bubbles, and we'll come back to that in a moment. That was in the late 80s. Vishy, good morning to you. You talk about the tailwinds that the financials will have in Japan, and this is critically important, isn't it? We move into positive rates, and the banks and institutions will begin to earn on some of their reserves.
Absolutely, and good morning, Manos. I think the wage hikes that we've seen coming through last year and what we are already seeing this year would really strengthen the conviction we already have in the earnings improvement. I think as our equity strategists have been highlighting this point for some time now, that this earnings improvement in the domestic companies in Japan is a very meaningful thing. And this is particularly for financials, as you said, moving into positive territory is a significant tailwind. So we could, I think this is none of us are really surprised that either the JGBs or the JPY, the FX or the rates markets really had any big moves on the back of this, because this was a widely and very well telegraphed, and there was really no surprise that it happened last night. There was just, so I didn't really expect much to happen, and in terms of the market reaction in the macro markets, and nothing did happen.
Listen, before we pivot to the Fed, Ethan, I want to just pick up on your point. You talk about a divorce from reality. You've reflected on bubbles and the nature of bubbles. I look at the Nikkei, up 19% year to date, 39% in the past 12 months, outperforming the US. Do you think that there is a hallmark of stretched euphoria in Japan relative to the rest of the world, specifically the US?
That's a really good question. I'm not sure it's relative to the US. It certainly is relative to China and other regions. There is a lot of euphoria in the US too. I think the question there is whether there's a bubble more broadly, or whether it's really just within AI, or whether there's a bubble at all. There's no doubt that momentum rules the day right now. And I suggest that in Asia, momentum is ruling the day in Japan as well, because there's simply nowhere else to go. There's too much hair on some of the other areas. And then within emerging markets, there's a lot of very toppy valuations as well. But good question.
It's interesting that in the Bank of America Fund Managers Survey, the pivot, the exposure, the delivery to exposure to emerging markets is the highest in 5-6 years. So there seems to be a reaching for breadth. Let's talk about what could disrupt risk, and I'm curious to get your take. Let's talk about the Fed. There is this sort of momentum behind the conversation that we're going to move from 3 dots to 2 dots. I've never been so excited or nauseated in my life, but to what extent would a move from 3 dots to 2 dots, the indication of a slower path to cutting, how disruptive would that be to equity and overall risk, Ethan?
I don't see a big risk to that. I think that's already been discounted in. I think there will, of course, be that parsing of words that the Fed uses. And if there's any more negativity in the words, if there's a reference to stickiness of inflation, I think that's going to be more triggering than the actual dot plot itself. Now, where is the risk? Yes, that this momentum algorithm goes wrong all of a sudden, and we do see risk off. We're also seeing this rising oil price right now, whether that's going to start to be a problem for inflation. So I think it's more about the words than the dots right now.
Vishy, I mean, I was reading Steve Englander's research before it came up, and it said, if the dots were to move, it would softly acknowledge the slower disinflation shift. But they need to stress the willingness to cut if it shows that inflation has continued to drop. So are you not as bothered as Ethan is if we move from 3 to 2?
I wouldn't say I'm not bothered from 3 to 2. I think the market will interpret the move from 3 to 2 as a hawkish signal coming from the market. I think it's a lot really depends on how this, if there were to be a change, and how this change is messaged both in the statement as well as in the press conference. That will be really critical.
Okay.
So
if they go from 3 to 2, Vishy, what does the bond market do? Because, again, people are now writing notes about 4.32 is critically important to the equity market. So if they move from 3, indicating 3 cuts to 2 cuts and muted language, what would that do to the yield market?
I think it's a combination. I think that they're going from 3 to 2 cuts and a messaging that's more hawkish. If the messaging signaling is more hawkish, and we could see, a 10-ish basis point moves in the long end of the curve, that we could definitely see that.
Ethan, let's just square off finally. The balance sheet has quietly driven by as well, hasn't it? It's gone from 9 trillion to 7.5 trillion, and we remain unscathed. How important is it for markets and liquidity that they slow the pace of the runoff? Briefly.
Certainly, with no shocks is what markets want right now. Markets want slow and steady, as was mentioned by your other guest, well-telegraphed move. That has been the order of the game. No surprises. Nobody wants to inject that kind of volatility. So yes, nothing drastic. I think what will have to be the name of the game. And as we can see, though, markets are more focused on corporate earnings and corporate rhetoric than they are on some of these macro indicators, unless it's the strong growth and the low unemployment that we've been taking a lot of comfort from. So I'd say, yes, nothing too surprising, I think, is the order of the day.
Okay, well, we'll dig into the corporates in just a moment when we dig into NVIDIA, the daily check. Ethan, thank you very much. Ethan, David, and Vishy Tripato stay with me to talk through the markets. Let's go under the hood of the bell. Ahead of the bell, Abigail Doolittle is side by side with me as she is every day. Abby.
Manus, let's start out with that daily check on NVIDIA. And we're seeing one of the rare down days this after been called.
So we're just going to come back to you, Abby, in just a moment. We've got one of those classic live TV. We've lost the sound. We had a lot of action. But as Abby was just saying, it is one of those strange days. You've got NVIDIA dipping. We'll dig into that story in just a moment. The AI event kicking off in San Jose, unveiling their latest and greatest chips.
The computer is the single most important instrument of society today. Fundamental transformations in computing affects every industry.
AI Woodstock failing to impress the street the morning after the night before. Will day two deliver any surprises? We discuss on Bloomberg.
In tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Your fixed income fix. Watch Bloomberg Real Yield at its new time Friday at 12 p.m. Eastern right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
The industry is being transformed, not just ours. Because the computer industry, the computer is the single most important instrument of society today. Fundamental transformations in computing affects every industry.
NVIDIA launching its much-anticipated AI event in San Jose. Unveiling the latest processor design, it's called Blackwell, and introducing new technology aimed at extending its AI dominance. Day one failed to impress the street. If you look at the stock price pre-market, we're down at just under 2%. Few surprises. Is that the correct assumption and take? Mandeep Singh is with Bloomberg Intelligence. I mean, it's almost like an Apple event now, isn't it? Where he held up the sort of the predecessor to Blackwell, saying to the market, this is the future. Define what the future, what is it that NVIDIA are going to offer us in Blackwell?
Yeah, I mean, when you compare Blackwell to Ampere and Hopper, their prior architecture,
This one is focused towards Gen AI training and inferencing. The last, two architectures were GPUs, which were used for AI training. But I think what they have done is really gone big in terms of customizing the chips for performing, for training and inferencing workloads. And the performance, 4 or 5 times their Hopper kind of release just shows how quickly the product cycle is accelerating for a company like NVIDIA. So the competitors, will find it hard to catch up in terms of performance. And we're talking about AMD and Intel. Yes, AMD has MI300, but I think NVIDIA is far ahead in terms of the performance that they can get with their chips.
And this is something you and I touched on a little bit earlier. I was sitting in the surveillance studio and you were there and you were saying, look, what is more concerning is perhaps the poor man's NVIDIA, or the poor woman's NVIDIA is falling further and further behind. How big is that gap? And in terms of cornering the market and market share for AI, if you look at NVIDIA relative to its peers?
Yeah, so what NVIDIA seems to be doing really well here is they are moving up the stack. They're not just providing you the chip, they're also providing you the networking. And there seems to be a lot of focus on the networking aspects, especially at the GTC. And, I find them releasing even microservices that competes with hyperscalers. So at the end of the day, they want to develop an ecosystem. Almost every large tech company announced a partnership with NVIDIA at the GTC. That just goes to show the power of the ecosystem they have built, and it'll be very hard for other companies to replicate that given the lead they have, on the product side.
I think it's interesting how the overall market obviously is at the mercy of Mag 7, and we are at the mercy of a mindset when we check NVIDIA price down 2%, 2.5%. The whole market seems to suffer. There's the performance over the past 3 months, which I think puts a better context around it. But we've also got this sort of mania out there. We've got YOLO traders, I think it is, betting that the stock could double by Friday, $1,940 calls. Now, look, that's a small trade with an extreme headline on it. But given the speed with which NVIDIA has grown in value, are these ludicrous kind of calls for a doubling in value? Moore's Law, it does not run forever.
And look, I think that's where expectations will get ahead of themselves. The fundamentals still look very strong to me. But, the CapEx cycle, the way we have seen it historically, is the above-trend CapEx will catch up, will slow down eventually because these companies are spending way too much compared to their historical levels, especially the hyperscalers. And given the concentration, I mean, they're all trying to develop their own chips. So even though NVIDIA has the lead, somebody will come up with an architecture that can mimic the performance, and the cost-benefit analysis will come into play at some point. So I do think that CapEx slowdown is a big risk for NVIDIA, and that's where valuations will matter. You just can't keep paying up for buying the stock here.
Okay, Mandeep, thank you so much. Mandeep Singh of Bloomberg Intelligence. Ethan Divitt is with me and says this: there is a convincing analysis comparing the current surge in chip makers to other infrastructure-led cycles. But the question remains as to whether the current euphoria has gone ahead of itself. Even a very simple question. You see a small drawdown today. I wouldn't call it anything to worry about. It's just a market which is reflective and it's selling the fact. But can this euphoria endure? I know you've done some work around bubbles. You've reflected on it. How much of NVIDIA is a manifestation of a mania or a bubble?
I'm going to say actually a much smaller percentage than we might think. I would actually maybe argue with your previous guest in that some of the spending perhaps is only getting started. What we can see is that there's something front and center of many minds is not being left behind. Just as FOMO is an issue for investors, it's an issue for companies too, and they know that even saying they're spending on AI gives them a boost to their valuations. So I'd actually suggest that we're only scratching the surface here. We've moved beyond the training stage, and we're now into the stage of integrating how this matters. So we have to always raise the question as to whether it's ahead of itself in the moment, and there perhaps is a little bit of froth relating to that momentum I mentioned before. But in terms of more spending, I see a lot more spending on this, on cybersecurity, on everything where the cracks can appear in our new cyber existence.
Yep, it is one of those paradigm shifts. Let's take it to the bond and credit gas. It's always an interesting conundrum to speak to a bond and credit investor when you see euphoria in equity markets. But here, the argument is this, is that 432 on 10-year paper was supposed to be an inflection point for the equity market. Could have spin it around, and this is what they were doing on surveillance this morning, which is when does the bond market catch up with the equity market?
Well, I think there are several threads you could go there in that context, what you just said. I think what's happening really is from the technology and innovation perspective, I think what we see this year as a year of this innovation moves into a broader diffusion, and that should result in some productivity gains. How quickly those productivity gains would be realized is still unclear, but I think we are looking for productivity gains to come that accrue to companies. From a credit perspective, and NVIDIA is a AA, is A+, highly rated company with not a tremendous amount of debt outstanding, and the trade's pretty tight. So not surprisingly, you will not have seen much reaction in the credit markets for this.
Okay, well, let's see. Ethan, as you say, we're in the foothills of perhaps a new paradigm shift in technology and AI. Ethan Devitt and Vishy Tripatora, my guest this morning on the markets. Coming up at your morning calls, Bank of America's Fund Managers Survey, something for everybody, shows risk appetite hitting the highest level since 2021. More on that conversation with Elias Gulu joining me shortly at the opening bell, right here on Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
What are the analysts saying on Wall Street? First up, Barclays upgrades 3M to overweight, highlighting the compelling valuation, the positive catalysts on the horizon. Next up, Redburn downgrades Snowflake to a sell, expecting little upside due to the limited AI products. And finally, Stevens raising a recommendation on Trust Financial to overweight, raising the price target to $43. Analyst notes there is an opportunity to increase on the earnings per share on Truist Financial as opposed to Trust Financial. Coming up in the show, we're going to take a deeper dive into the Bank of America Fund Managers Survey in terms of the sentiment, their risk appetite, the highest since November 2021. And there is a reach to emerging markets. Bank of America Survey in focus next on Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The deal?
The deal. The deal. That deal. The deal.
Huge deal.
Who dug this up? What are y'all in trouble?
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
Or other authorities.
Could face bigger challenges next.
Was going to keep rating World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bit of a drag on these markets this morning. NVIDIA and the other chip makers all just taking a little bit of the heat out of the market. The AI, the Woodstock for AI was slightly underwhelming. Our last guest, although, said we are in the foothills of a technology revolution. Can NVIDIA, however, continue to propel higher at the same kind of velocity? For right now, we're down by 1/8 of 1%. NASDAQ futures lead us lower by 1/2 of 1%. And the debate for the Russell 2000 is to what scale will the dots be scaled back from 3 rate cuts indicated to 2 potentially. Across the rest of the assets, dollar yen down for, well, this is dollar up and yen down for the 6th day in the row. The Bank of Japan finally raises rates, their first hike in 17 years. There's a split to the Bank of Japan, hence the reason why the market is unsure that you're in a new cycle of rate hiking in Japan. Bitcoin is down by 5.58%. There was a massive outflow yesterday from Grayscale. The ETF posted its biggest daily outflow, I should say, on March the 18th, $643 million. So a little bit of dislocation in the flows from not just Grayscale, but other ETFs as well. Yields dropped by 1 basis point. Nothing to write home there. We are in the midst of counting down to the Fed. What will the dots give us, and what will the conversation be from Jay Powell? One stock to watch, as I say, it is NVIDIA, kicking off its AI conference with a new processing chip named Blackwell, failing to deliver any big surprises. Has that left investors wanting more for day 2? Ed Ludlow is with me. Blackwell has underwhelmed for now.
Yeah, I don't know that the performance of Blackwell, or on paper what Blackwell is capable of, is underperforming. It's very much a sell the news kind of event. We got everything that the street expected but also hoped for, and a number of analysts on the sell side at least are looking at the relative performance of Blackwell to the prior generation Hopper, or as we know it, H100. So 2.5 times performance on the training side, 5 times on inference side, and when clustered, the Blackwell has 25 times power efficiency. And as we scale up the infrastructure on the data center side that relates to the AI build out, power is a really big consideration. The board on your screen is really interesting because there is a feel good. It is all of the end user customers that Jensen Huang name checked on stage, in particular Dell, up a percentage point. And what Huang said, the NVIDIA CEO, is that there is no one better at building out that full server system than Dell. We knew this was coming. The question is how quickly NVIDIA can ramp and scale output. They did that incredibly quickly with H100. Blackwell starts shipping at the end of this year. And if you look at whatever function you use on the Bloomberg terminal, EEO or MODL, the expectation is that in the coming fiscal year, we see a continuation in the surge of that data center revenue for NVIDIA. I'd also point to some of the other things. We've got some evidence that NVIDIA is now starting to monetize its software offering, which is something that the street was looking at closely. But I'll be heading to GTC straight after my show, Manus. I'm told by those on the ground it is living up to the name of Woodstock for AI, but I'll report back to you tomorrow.
Very good. Identify those boomers, Ed. They sort of look a little bit older than me. Ed, I'll leave that with you. Ed Ludlow, chasing the great prize that is AI at the conference. Let's turn to the consumer space. Beyond Meat is filing a $250 million mixed security shelf registration. Abigail Doolittle has the D-littles. Please explain what that is.
I absolutely will. But first, let's stick with chips, because Beyond Meat is not the only company out there with a public offering. I'm talking about Super Microcomputers. They make servers that are stuffed with some of those NVIDIA AI chips. That's part of the reason that over the last year, this stock up about 1,200% at the peak. Since then, it has given some of those gains back into yesterday when it was added to the S&P 500, down a little bit, and now today down 8.6% on their plan to sell 2 million shares. And of course, that has everything to do with the possibility of dilution. It will bring dilution, so investors don't like that. One thing to point out, though, here, Super Microcomputer, unlike Beyond Meat, highly profitable. Last year, they put up $12.79 per share in adjusted earnings. When we turn to Beyond Meat, what they have done, they've filed a $250 million, so much smaller, mixed security shelf registration that could include stocks, bonds, preferred warrants, we don't know. And it does not mean that the sale will begin, and it doesn't mean that it will ever happen. But in this case, because Beyond Meat is deeply, deeply unprofitable, last year posting a loss of $4.93, if any of those securities, if they do sell securities and they happen to be on the equity side, it could really dilute and make a loss even deeper on a stock, unlike SMCI, down 45% over the last year.
Okay, Abby, thank you very much. Let's dig a little bit deeper into the crypto story. We checked the price of Bitcoin as we started this session. Stocks linked to the digital asset slipping. Grayscale ETF posting the biggest daily outflow. Simone is with me. Simone, it's been a bruising 2 days for Bitcoin. Just beef up those details for me.
Yeah, well, the Grayscale Bitcoin Trust lost $643 million in terms of outflows yesterday. That's the most of any day since it turned into an ETF on January 11th. Now, that in and of itself is not so surprising because GBTC has been seeing outflows pretty consistently since then. But what may be more surprising is that the inflows into other ETFs in this space, the other 10 ETFs, are not making up for it as they had been for the past 2 months. In fact, of those other 10 ETFs, we saw net outflows of $154 million. That's what's sending Bitcoin to its lowest level in 2 weeks. That's what's hitting those other crypto-linked stocks, especially ones like MicroStrategy, which announced this morning that it had actually paid more than $600 million to buy over 9,000 Bitcoins. You look at Marathon Digital Holdings, you look at Coinbase, all of those stocks taking the heat this morning. Now, crypto trading firm QCP Capital, they're out of Singapore, saying they will be closely tracking the aggregate ETF flow numbers today because a net negative would be a distinctly bearish signal. All of that being reflected so far today in the price of Bitcoin, now down to, it looks like, $63,600, as well as all these crypto-linked stocks, Manus.
Okay. Certainly a lot of angst in crypto land. Simone Foxman there. Bank of America's latest fund manager survey has been released, and the investors are going global from US tech to Europe. And Katie Greifeld has the breadth and reach of this survey. Katie.
Well, Manus, it was pretty bullish across the board and across the globe. Let's go through some of the size and scopes here right now. Risk appetite was at its highest since November 2021, which makes sense when you take a look at global growth expectations, highest since January 2022. Going down the list, the allocation to stocks was the highest since February 2022. And what gets interesting here is that we're not just talking about U.S. equities. You take a look at the allocation to EU and EM stocks, that is the highest since May 2023, with the poll showing really a big rotation into Europe, EM, and financials, interestingly. So again, it's not just about these U.S. stock markets here, but let's get into the crowded trades. This was a really interesting section, and it's, as you would expect, the long Magnificent Seven trade was quite crowded at this juncture. Short Chinese equities, that also makes sense, but long Japanese equities, long Bitcoin, and long cash. That is very interesting, Manus. Of course, with all this bullishness on equities, on risk assets, you still have the average cash level ticks up to 4.4% from 4.2% of AUM, and you have strategist Michael Hartnett writing that that cash level measure, once it gets to about 5%, that's a buy signal.
Okay, there's a lot to chew on there, Katie. Thank you very much, Katie Greifeld, with the latest from Bank of America. Joining me now is Elias Gulu to discuss some of these findings. Good to have you with us. I mean, I was listening to Candace Browning this morning. This is very much a reach for global return would be one of the top takeaways here. I mean, global growth expectations are at a 2-year high, equity allocations are at a 2-year high, but there is a real reach here for beyond the US.
Hi, Manus. It's great to be here. Thank you very much. Yes, if I had to actually summarize the big takeaway from this month's Global Fund Manager Survey, it would be optimism. We saw optimism across the different metrics we typically look at. As you just said, global growth expectations are the highest in the past 2 years. Profit expectations are the most optimistic in the past 2 years. Stock allocation at a 2-year high. And more importantly, this optimism is now seen in the risk appetite, which is the highest since November 2021. So investors are bullish about the macro. Investors are more confident that the economy will avoid a recession. And what do investors buy when they are confident about the macro and the markets? They buy international equities. We recorded the largest pivot into Eurozone equities since June 2020, the largest pivot into EM equities since April 2017. And on the other side, in terms of sector, they also buy financials. That's why we saw a big rotation into banks.
And still, day to day, we talk about how stretched the concentration is within the Magnificent Seven, within technology. And I was drawn to the bubble question in terms of AI being in a bubble. This is a split. The market is very, very closely split here. 45% say no, and 40% say yes. So this is, how is that evolving, or how has that evolved?
This is a question that we actually asked in the past, and about a year ago, investors were not thinking that AI was a bubble, and now, as you said, the split is very close, but still, investors believe in AI structurally. They believe that the current valuation of the Magnificent Seven, of any AI proxy, is not bubbly, and I would say it also adds to the element of confidence. You have a big conviction that the global economy is headed towards a soft landing. 62% say that the economy will experience a soft landing. About 2/3 believe that there will not be any recession. You have also a big conviction that rates will be lower, both short-term and long-term rates will be lower. If you add to that this expectation and this belief that AI is not in a bubble, there is no risk of a bubble, I think that's a very powerful cocktail for confidence, and that's what we see in the data.
It's interesting, a year ago I was in Zurich reporting on the demise of Credit Suisse, the birth of one of the biggest new systemically important banks, which is UBS, worth over 100 billion now. And then we were talking about regional bank failures here in the United States of America. Do you think that we've gone past the worst of those fears from systemic risk at the UBS Credit Suisse level and the regional bank level here in the United States?
When we typically ask our FMS participants what they think is the most likely sort of a global systemic credit event, and this month it was US commercial real estate. In the past year, that question has been mostly focused about the commercial real estate and the real estate. In US, it's commercial. In China, it's the property sector as a whole. But investors are still worried about commercial real estate, less about banks, because, again, they believe that rates will be lower in 12 months' time, and that's good for the financial system.
And U.S. equities still remain top billing. I mean, we're talking about the globality of this fund manager survey. The reach into EM, as you said, one of the biggest pivots since 2017. But still, in terms of the United States, are there any idiosyncrasies, any selling going on at these upper levels, at these records that we've been putting in the first quarter?
Of course. Well, in fact, last week we just recorded the biggest inflow ever into U.S. equities. So valuation here are not a particular problem for investors. But just focusing on the fund manager survey, when you look at the allocation across the different assets, you still see a very significant and notable overweight regarding U.S. equities. But this time, because investors are more bullish about the global growth prospect and about the profit growth prospect, they pivoted away from what they like, as in U.S. equities, and whatever is big in terms of U.S. equities, tech, healthcare, growth in general, and they bought international equities, which is less overvalued and with good growth prospects.
Elias, thank you so much. Great context around the survey.
Pleasure.
Elias Galou from Bank of America. Let's get across to Abigail Doolittle. A little bit of breaking news on the retail side from Nordstrom. What have we got, Abby?
Yeah, we have the shares of Nordstrom spiking right now up about 11%, heading to the best day in more than a year on the headline that the Nordstrom founding family seeks to take the company private. This according to Reuters. They did, of course, try to do this unsuccessfully about 6 years ago. The largest shareholder is Bruce Nordstrom, owning about 15.5% of the public float. According to another source, Nordstrom has asked both Morgan Stanley and Centerview to reach out to private equity firms and gauge their interest for a potential deal. But again, we do have the headline that Nordstrom's founding family is seeking to take the company private, and the stock is soaring up 11% on this news, Manus.
It is pumping up higher. Abby, thank you very much. Coming up in the show, 1 year since the fall of Credit Suisse.
There hasn't been the kind of change there was last year, because there are unique business models. That's what's not involved. A little bit of it, and so nothing we're seeing. And by the way, we see a lot of flows, and we don't see it anywhere.
We'll dig into banking next on Bloomberg.
Covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays only on Bloomberg. Context changes everything.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well, because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years. An investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
There hasn't been the kind of change there was last year because, there are unique business models. That's what's not involved. A little bit of it, and so nothing we're seeing. And by the way, we see a lot of flows. We don't see it anywhere. And the industry is well capitalized, has good liquidity. Believe me, from last year to this year, people shored up their liquidity across the industry.
Well, today the markets mark 1 year since UBS took over Credit Suisse, its rival. The deal has pushed UBS's market cap past $100 billion to the highest level in almost 16 years. Sonali Basak joins me now. A year ago, I was standing on a rooftop in Zurich, and we were talking about whether this was an amazing steal for Motti and Kelleher, the team that put this deal together. And it is. I mean, it's triumphant. The amount of assets they manage now is $5.7 trillion. The stock's worth $100 billion. What's gone right so far?
Yeah, it's interesting. You even have JP Morgan analysts saying that they have a better business mix than Morgan Stanley. Remember, Morgan Stanley doesn't have as large of an international wealth manager, and that's obviously a massive opportunity for UBS as they continue to gain share under this combined wealth and asset manager. Now, the big question marks remain profitability and improving those margins. You may remember, even before the deal had happened, that UBS and its presence in the Americas in particular, and the cost of building that wealth manager out has always been a massive focus. And you have UBS Chair Colm Kelleher even pointing to the fact that this year will be a year where a lot of investment is needed.
But then how do they grapple with that? Because the cost ratio here in the United States is higher. The model here is fundamentally different to the wealth management model in Europe and the Middle East. So how do they grapple with that? How do they grow market share here? We had Ralph Hammer's, some would say it was an ill-fated robo-advisor deal that he tried to put together here, which was cast aside. How do they grow? How do they compete? How do they get the valuation that Kelleher wants against Morgan Stanley?
This is the
that's the holy grail for him, isn't it?
It's the million-dollar question, and you've got to say in some ways he's kind of lucky because Morgan Stanley is going through a transition of their own when you think about the CEO transition and what is happening there. If you look at the stock this year, you have actually UBS up, whereas Morgan Stanley is a little bit down on the year still in the middle of all this. Now, again, they are still tens of billions of dollars away in market cap, but you do see an interesting dynamic here. Remember, you did have UBS CEO Sergio Armati saying that he would sacrifice top-line growth here to improve profitability and grow reasonably. For Sergio Armati, you know this more than anybody, that it's always been not just about growing the top line, but making sure that the profit makes sense. And we're not just talking about the wealth manager here anymore. We're also talking about investment banking. And you can say that they've already hired this massive team from Barclays and elsewhere where they're repositioning to gain more share at a time where we know it's been tough. Deals are just coming back. Competition is hot, but they do have a new team in place.
Yeah, I mean, he is laser focused on return on equity, and it has always been his mantra. Very briefly, we're in bonus season. Where are we on the payouts this year relative to last year? A little bit slimmer?
A little bit slimmer last year, but the hope is that it'll come back this year. And remember, the reason that the New York City Comptroller keeps such a close eye on this, Manas, is because, of course, this goes back into the money that goes back into the city. And so there is a hope that this will increase. Actually, headcount did increase Wall Street wide. And so that is a little bit of a perk to show you that perhaps the banks are preparing for a brighter future.
Okay, it just depends which bank you're at and whether you're in the lowest performing quartile. Sonali, thank you very much. We'll see a little bit more Sonali later in the day. Coming up, we'll get into the sector price action for the morning. Abby, what have we got?
It's very interesting this morning, Manus, because we have a decline for the S&P 500 right now of about 0.25%, but most sectors, interestingly, are higher. So let's talk about those first. Utilities, that is one of the defensive sectors. We have yields down, so the dividends of that sector look more attractive. Energy higher as oil climbs just a little bit. To the downside, it's all about the mega cap tech sectors, both communication services. We have Meta, Alphabet, Netflix, Disney, AT&T down. We also have technology down about 0.8%, and I don't need to tell you that has everything to do with the chips. In fact, let's take a look at the chips, because over the last 5 days, we do have the stocks down nearly 6%, or maybe more. And I don't need to tell you that has everything to do with the chips. In fact, let's take a look at the chips, because over the last 5 days, we do have the stocks down nearly 6%, or maybe more than, almost 7% at this point. This, of course, is NVIDIA and is dragging, but also taking a sympathy trade with some of the other chip companies, such as AMD. And that is one reason why we have the S&P 500 tech index down 2.8%. That was the index that put in the first record high last year, Manus. Let's see whether or not it's now telling us that we're seeing some kind of inflection point to the downside, at least in the near term.
Okay, Abby, thank you very much. Coming up, we'll give you your market-moving events that you need to keep a note of in your trading diary.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
They're nervous in these equity markets. Day two of the AI Woodstock with NVIDIA today. Let's see what they say there. But there is a nervousness. The NASDAQ is down. NVIDIA is lower. We're just seeing some of these chip markets under a bit of pressure. Keep your eye on Nordstrom belting higher, up by 12%. Will the company go private? The bid is now being worked on. We understand some of the bankers have been discussed with. We'll leave you with that view of the red on the markets at the moment. NASDAQ down 0.75%. This is what you need to know for the rest of your trading day. Wednesday, we get the Fed decision, Chair Powell and his news conference. Thursday, it is the Bank of England. Plus, stateside, we get another round of U.S. jobless claims and PMIs. Finally, Friday, we get the Atlanta Fed President Raphael Bostic kicking in to Fed speak. That was countdown to the open. Surveillance was on tour. We're all back in the House of Bloomberg tomorrow, and we'll do it all again.
Top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices. They all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great
question. Best question I get all night. Bloomberg, top experts, great questions.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Tuesday morning from the Bloomberg Interactive Brokers studio in New York City to our worldwide audience. We have Molly Smith here sitting in for Alex Steele because Alex is down in Houston badgering some, I think, executives from the energy companies. That's what she does.
We'll get a check-in from her a little later in the hour.
Can we talk a little tennis during the next 2 hours?
We're going to talk a lot of tennis.
Okay, because a lot of stuff has been happening here. So we'll get
a lot
the latest
of news,
with
everybody.
Molly Smith, in addition to covering all the stuff she covers on her beat and for Bloomberg News, she's an expert on all things tennis. We tend to get some updates there. You're listening to Bloomberg Intelligence. We focus on companies, stocks, bonds, all that kind of stuff. We rely heavily on the research department of Bloomberg Intelligence, where they have 400 analysts covering 1,200 stocks, 130 industries. They are the best on the street, and we lean in heavy with those folks. So we'll do that. Looking at the markets here, kind of red and green on the screen. Let's kick things off this hour with Lisa Mateo on a Bloomberg Business Flash.
You got it. Yeah, stocks mixed after a big tech push the stocks higher yesterday. NVIDIA had a lot to do with that, but this morning the excitement of its newly unveiled AI processor called Blackwell starting to fade. We have shares down about 3% right now. So let's take you back over to the markets. We have the NASDAQ down about 0.6%. The S&P 500 down about 0.2%. The Dow up about 0.1%. Over to the 2-year yield at 4.69%. That's down about 3 basis points. The 10-year yield at 4.31%. That's down about 1 basis point. To commodity spot, gold lower at $2,151 an ounce. And we'll take you over to oil at Brent crude, $87 a barrel. Currencies, the dollar is stronger, the Japanese yen weaker on the BOJ's dovish tone. We have the euro, British pound weaker, Bitcoin at 63,174. Today, the Fed heading to the day one of that 2-day meeting on interest rates. We also received some housing data earlier this morning. New U.S. home construction in February beat forecasts, reaching the highest since August. Building permits They rose too. That is your Bloomberg Business Flash. Paul and Molly.
All right, Lisa Mateo, thank you so much. We appreciate that. Molly Smith sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube.com. So search Bloomberg Podcast on YouTube.com. That's where you'll find us here. All right, security to access the Bloomberg terminal. It is extensive, including they take a fingerprint thing. Okay, now the fingerprint reader,
very tight security in here.
Yes, and we were way ahead of everybody. That's how they do it here at Bloomberg. So and you need a fingerprint thing. So the trick, if it's not reading your fingerprint, is to lick your finger and then put it on. Now, people that are don't want to get germs and that kind of stuff, like adults, they don't want to lick their finger.
I mean, I don't blame them. We're in New York City. Who the heck knows where your finger's been today?
Yeah,
I don't know. I mean, the subway,
I lick my finger, works just fine. I was born and raised in New Jersey. I've survived every carcinogen there is in the world.
COVID?
I'm not worried about licking but some guests with discerning taste, like our next guest, Abigail Doolittle, does not do that, and so she may or may not have access to her terminal. Abigail Doolittle, she covers all the markets for Bloomberg. We really appreciate getting a few minutes of her time. It's kind of mixed here today, Abigail. I'm not sure kind of what's happening. I guess everybody's just kind of waiting for the Fed.
It is a little bit mixed, and I was able to get on my terminal.
Nice. All right.
On the phone, the backup worked, and then finally I was able to do the finger swipe without licking.
Okay. All right.
There are
a lot.
My reason to not lick my finger is because after swiping 5 or 6 times on the finger swipe, who else has been swiping?
Exactly right.
So
it makes perfect sense.
in any case, we do have stocks off the lows. The S&P 500 right now down about 0.2%. The NASDAQ 100, though, down sizably more, down about 0.7%. And this, of course, has to do with the NVIDIA weakness, down 2.9%. In sympathy, we also have AMD. In fact, it seems to be the NVIDIA selling that we're seeing, because I think that there's this sense that the 95% year-to-date rally just last week or the week before maybe was a little bit too overdone, and that maybe that's true for some of the other big tech names. So today we're seeing a real wide sector movement to the downside. NVIDIA, Meta, AMD, Tesla, Broadcom, Google, Supermicro Computer. We can talk more about that one because there's more of an idiosyncratic reason for that stock to be down. All down. Netflix, Qualcomm, it goes on in terms of the biggest point drags on the S&P 500. And NVIDIA, of course, they did kick off their developer conference yesterday. It continues. They delivered in terms of talking about new chips, but it's one of those sell the news events, maybe just not enough to justify up, let me say it again, 95% in about 2 months.
Wow.
There's probably
on a massive stock.
On a massive
We're not talking
market.
about like a penny stock.
Yes.
There's probably also got to be a little element of we're in a bit of a holding pattern before the Fed tomorrow going on here, just looking at a broader index level, right?
Absolutely. And I would say that technology overall is going to be more sensitive to that, just from the standpoint that if the Fed does not indicate, and yesterday Fed Swap said that there's 50%, less than 50% chance that they cut in June. Let's not forget that a couple weeks ago, traders had them pricing cutting in tomorrow, or pricing in a cut tomorrow. At one point last year, 7 cuts, and then the Fed came out and say, wait, our dot plot shows 3. So now the street's at 3, but the timing of it keeps getting pushed down. If the Fed, in their policy statement, or more likely if it were to happen in the conference, if Fed Chair Jay Powell in any way indicates that 2024 is not going to be the year of the cut because inflation is too sticky and then it's the presidential election, they don't want to do it around that time and get political, then, it could be interesting because that, I think, would cause a real repricing of risk. I think that we've seen some of it because bonds, we do, of course, have yields down a little bit today, but over the last month or so, up, 30, 40, 50 bips. That 2-year yield has snuck up to a 4.70, not so far away from a 5%. So traders definitely want to know what the Fed's going to say. And tech stocks more sensitive because if the liquidity stays out of the market, it makes that valuation look a little bit more rich.
I'm a little surprised that the equity market has performed as well as it has this year in the face of what I guess are now expectations coming down of a rate cut. I'm wondering, does that surprise you at all?
It's not surprising to me, only because we've had traders just so off sides from the Fed now for a couple of years.
True,
now, the interesting thing about it is it had been bond traders in 2022 when stocks got it right, because Fed Chair Jay Powell and the Fed was very clearly saying, listen, we're going into a very aggressive tightening cycle. Stocks did sell off, almost a bear market. Bonds, on the other hand, really didn't follow the path, so therefore you had fact, yields whipsawing up and down, falling. Right now, it seems as though bond traders are taking, after learning their lesson over that painful year and a half, 2 years.
Taking them a couple times.
Yeah, taking them a couple of times to learn the lesson. They seem to be taking the cues of the Fed that maybe rates are going to stay a little bit higher for longer than expected at the end of last year. But stocks don't seem to be buying into that yet.
Yeah, it's interesting.
But there are subtle signs that folks are worried.
Okay.
Yeah.
All right, very good. Abigail Doolittle, thank you so much for joining us. Abigail Doolittle, she covers all the markets so well for Bloomberg News, TV, radio, the whole shebang. So appreciate getting a few minutes of her time. Market Drivers was brought to you by Interactive Brokers. Interactive Brokers charges U.S. dollar margin loan rates from 5.83% to 6.83% rate subject to change. Learn more at ibkr.com/compare. I remember when that billboard was 0.83% to 1.83%. Now it's moved up a little bit.
How the times have changed.
Right in line with the Fed. So Interactive Brokers keeping pace there. All right, let's check in with Ira Jersey. He is our go-to guy on markets, the treasury markets that really prices in kind of where this Fed may want to go here. Ira Jersey, Chief Interest Rate Strategist for Bloomberg Intelligence, joining us from the confines of our Princeton University, our Princeton, New Jersey set down there. Ira, again, not looking for anything tomorrow, but you're the smart money. When we've heard of the smart money, we talk about the Ira Jerseys of the world. What are you going to be listening for?
Yeah, I'm going to be looking for a couple of things, Paul. So number one is balance sheet policy. You know, we've been waiting for more information and details on how that was going to develop over time. And at the last meeting, Jay Powell said, hey, the next meeting, we're going to start talking about what we're going to do. So I'll be listening in this post-meeting press conference as to what are the options maybe they're considering. There won't be any decisions, and they won't make there won't be a lot of detail yet, but you know, what are they thinking in terms of timing and also in terms of size of how they're going to cut back their asset runoff. So that's number one. And then number two is obviously some of the nuance and details. How do the dots change? And in particular, I'm not going to really look at the 2024 dots. You know, there's a lot of focus on that, but it's the 2025 dots that are going to matter for like the long-term end of the Treasury market and also for the mortgage market. So look at those 2025 dots. How low does the Fed still think it's going to cut interest rates? Is it going to be lower than what they've said, or maybe are they going to cut a little less than they said based on their projections of those dots?
Well, let's get into the projections also a little bit more. This is going to be the first updated summary of economic projections we're going to get this year. So the 2023 dots at the end of in December that we saw had those 3 cuts priced in for this year. As you said, maybe the 2024 dots less interesting than 25, but we're also going to get updated inflation projections, updated GDP projections. Any movement you sense might happen in there?
Yeah, I think that the GDP projections maybe not so much, but the CPI projections and the PC, core PC projections probably have to move up a little bit, just based on the data and information that we've gotten so far. I would be pretty surprised if we didn't get an uptick in the what they call the central tendency. So keep in mind, when you see the summary of economic projections, they come up with what's called a central tendency, which is a trimmed mean. They take off some of the outliers and then say, here's the central tendency that we think that CPI and GDP are going to be in this year. So I would be pretty surprised if those didn't come up. The other one to watch, of course, is going to be their expectation of the employment situation. So where's the unemployment rate going in their forecast? Because that is obviously the second key to their dual mandate besides the inflation. Besides inflation. So right now they don't have to worry about the employment situation because things are very tight. So 3.9% unemployment and the like. But if their forecast suggests that maybe employment's going to remain better than what the December SCP had said, then there's the possibility that maybe at some point in the not too distant future, they might go from 3 cuts to 2 cuts in the dot plot come June. Of course, there's a lot of data we get before then, but I think that in order to prepare the market for that, one of the ways that it can do so without having 2 or more members move their dots up would be to say, hey, we actually think the employment situation is going to be better than we thought just 3 months ago.
So, Ira, you know, WIRP Go, the work function, we started the year with the market pricing in approximately 6 rate cuts, and we're now down to approximately 3. Does that seem more realistic to you?
That's been our call since last October.
Yep.
So yeah, it's like come back. Quite frankly, that pricing of 6 cuts was one of the 3 things that we highlighted as maybe being the biggest mispricings in the rates market. That and also inflation expectations, because we had 5-year inflation expectations earlier in the year approaching 2%, and we thought that was somewhat too low and unrealistically low, and that they would probably have to come up. So 3 cuts at this point seems reasonable. It's because, obviously the Federal Reserve could cut 5, they could cut 1, right? They could cut 0. So I think that's a more reasonable midpoint of potential outcomes than was the 6 cuts that were priced in January. And you look at the rest of the Treasury market, like 2-year yields at 4.7%. 2-year yields are exactly pricing for 3 cuts this year and 3 cuts next year. So I think that those are pretty close to fair value. When they were down at 4.4%, they were obviously a little bit overpriced, and now it's more realistic pricing, I think, for the potential policy outcomes.
How much do you think Powell is going to get into the cadence of rate cuts? I think it was maybe Vice Chair Jefferson who had brought up recently that I think it was in Greenspan's tenure, that the Fed had cut and then waited a couple meetings, cut again. So maybe the stop and go nature of coming down, if Powell might allude to how that spacing is going to play out.
Yeah, I doubt that the chair is going to say anything completely outrageous. So he'll leave his options open. But I wouldn't be surprised if he mentioned that a stop go, or not going every meeting, not cutting every meeting, is a realistic possibility. And clearly, three cuts this year would require them to skip at least 1 meeting, if not 2, depending on when they started, right? So it wouldn't surprise me personally if the Federal Reserve did cut in June and then waited again until September to see what the economy was doing. You wind up getting almost 3 more months of data in between June and the September meeting. So given that, I think that going in June actually gives the Fed a lot more optionality. Cutting in July would also give them similar optionality, where maybe they cut in July and then they don't cut again until November, and then wait till December, right? And there's the possibility that if the economy continues to be pretty good, then there's no reason for the Fed to necessarily cut in December, and you only get 50 basis points of cuts this year. So that would not be a surprise, going in a measured pace, right? Something like that. That was the Greenspan hiking cycle back in the mid-2000s, when he said, we're going to go to measured pace. So this could be something similar. It's been hard for the Fed in the past to calibrate things that way, because they've always been reacting to some crisis or some massive downturn in the economy that was where they were behind the curve. So I think the Fed at this point would like to get in front of the curve and start to cut. The risk is that they make the mistake of re-accelerating inflation, right? And that's something that a lot of market participants are very worried about as well. So the Fed is in a tough place right here, quite frankly. So doing nothing is actually the path of least resistance, at least until it's clear that the economy is slowing enough that they can feel comfortable cutting rates.
Yeah, well, I mean, there's going to be a kind of a high bar to get that amount of slowing between now and June. Now, I mean, looking at the data that we've gotten for the first 2 months of the year, it looks like inflation is still pretty firm. The job market's still pretty strong. Haven't really seen a ton of that, slowing activity that Powell said in his congressional testimony, that they're not far from getting that level of confidence to start cutting rates. But I don't think we've really gotten much news since those comments that would make them more confident.
Yeah, I don't disagree with that. I think that's the reason why the market's now pricing for a July cut instead of a June 1st cut. But you still get another 3 months of data. There are some signs that the economy is slowing. When you look at some of the survey data, for example, you're seeing some confidence levels going down a little bit. You do have some areas of consumption that are slowing pretty meaningfully. So all is not great, but it's also, as you note, it's fine, right? And fine means that the Fed doesn't necessarily need to cut interest rates. What the Fed would love to do
is to kind of cut interest rates following how much inflation is falling. The challenge with that is which inflation measure you're targeting, and does the market understand that? And I think that that's maybe a communications issue that Jay Powell and some other members of the Fed could address, because are they happy with having the Fed funds rate 300 basis points above inflation based on one of the measures of inflation? That's where it is, and that would seem to be high and very restrictive. And that's one of the reasons why when Jay Powell or Chris Waller or some of these other members of the Federal Reserve say that rates are restrictive, that's what they're talking about, right? That difference between the Fed funds rate and inflation.
All right, Ira, great stuff. Really appreciate getting a couple minutes of your time before this important Fed meeting tomorrow. That's Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Coming up next, we're going to check in with Phil Orlando, Chief Equity Strategist with Federated Hermes, on these markets ahead of the Fed tomorrow. S&P 500 is off 0.25%. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Stocks are mixed, and this is ahead of the Fed kicking off a two-day meeting on interest rates. Senator Elizabeth Warren, she is speaking out about rates. She's urging Federal Reserve Chair Jerome Powell to cut them to help struggling clean energy. Right now, we have the NASDAQ down about 0.7%, the S&P 500 down about 0.2%. The Dow is up 0.1%. Over to the two-year yield at 4.69%. That's down about 3 basis points. And then we have the 10-year yield at 4.31%. That's down about 1 basis point. To commodities we go, where spot gold is lower at $2,150 an ounce, and over to oil Brent crude at $87 a barrel. Currencies, we have the dollar stronger, Japanese yen, yes, weaker, British pound weaker, Bitcoin at 62,557. That is your Bloomberg Business Flash. Paul and Molly.
All right, Lisa Mateo, thank you so much. We appreciate that. Molly Smith, Paul Sweeney live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube, so you just have to head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Bloomberg Radio, that's another way to go as well. Again, waiting the Fed tomorrow. Not much is expected from the Fed in their statement and from Jay Powell. Steady as she goes. I guess markets is trying to get a sense of when the Fed will begin cutting rates this year, or is there a scenario where maybe they push it out to next year? And it certainly is impacting the markets. Let's check in with a professional on this stuff, Phil Orlando, Chief Equity Market Strategist and Head of Client Portfolio Management at Federated at Hermes. He joins us via Zoom. So, Phil, what are you looking for from the Fed tomorrow, and do you expect it to change your outlook?
Paul, good morning. Thank you very much for having me back on. We are very much out of sync with the market. As you and I talked, I guess earlier this year, the consensus view on Wall Street was that there'd be 6 or 7 rate cuts this year, with the first one starting tomorrow, due to immaculate disinflation and the immaculate pivot thesis. and we just didn't see that. We were sort of in the 3-cut camp, with the first one coming maybe in July. July, November, December was sort of the way we were timing this out. And what's transpired over the last couple of months is that inflation, as we discussed, is a little sticky or a little more persistent than perhaps the consensus thought. And the Fed, recognizing that, has been trying to tamp down some of this enthusiasm for a significant number of rate cuts. So fast forward to tomorrow. We expect the Federal Reserve to do literally nothing. We still think that first cut is coming in July. And I think the market is going to talk about what we've seen with CPI and PPI and PCE over the last 4 or 5 months, in that the rapid decline that we saw from the middle of 22 into the end of 23 has now gotten choppy. When we've actually seen an increase in inflation a little bit over the last couple of months due to energy and food prices and housing and labor cost pressures and all the things that you and I talked about earlier this year.
What's the trade that you're preparing for, Phil, in terms of tomorrow? Maybe you and your team, if you've played, run out a few scenarios. Obviously, the interest rate move being expected to be 0, but looking at more in terms of what might happen with the dots, what might happen with the economic projections. Have you guys come up with a game plan of how to move in either direction depending on what those materials show?
Fabulous question, Molly. And there are 2 parts to this. I want to focus on the dot part of your question first. And the one thing that sort of confounded us at the last SEP a week or so before Christmas was the Fed's forecast that core PCE inflation would get to their 2% target, but by the end of calendar 26, literally 3 years from now. And we're at 2.8% now, down from 5.6%, a year and a half ago, 2 years ago. So in our minds, we're saying, okay, is the Fed being too conservative because they screwed up that whole transitory thing a couple of years ago and they don't want to make the same mistake twice? Or are they trying to tell us something that they recognize, taking a really deep dive into the data, that achieving this last mile, getting core PC down to 2% is going to be really hard. And we need to adjust expectations within the market. So that's sort of one issue. What does the Fed do with that dot, that 2% core PCE by the end of calendar 26 dot? Did that stay exactly where it is? or do they move that up? Second point is the market question. How do we invest for this? And over the last, say, 3 or 4 months, there's been a significant divergence in the marketplace. Benchmark 10-year Treasury yields, which were 3.8%, in the fourth quarter of last year, are now sitting at 4.30. All right, so we've backed up 50 basis points in Treasury yields over the last couple of months. The S&P 500 is up 9% year to date. It's up 27% since its low the end of October. That's incongruous. That there needs to be more in sync. Frankly, I think the bond market's got it right. The backup in rates over the course of the last couple of months, because of the disappointment with inflation, in our view, is the right move. Equity markets seem to be overly optimistic, and perhaps that's because of the performance of what now turns out to be the Mag 1. NVIDIA is nearly a 10-bagger over the last 18 months. Now, NVIDIA is down about 13% over the last couple of weeks. So maybe from that oversold position, NVIDIA is going to start to ratchet back to more reasonable valuation levels. And maybe the equity market, reflecting what's going on in the bond market, but begins to come back to more reasonable levels as well.
All right, we're speaking with Phil Orlando, Chief Equity Market Strategist of Federated Hermes. Coming up in just moments, we're going to bring you a TV simulcast. Bloomberg's Alex Steele. She's speaking with Dow CEO Jim Fitterling in Houston, so we'll bring that to you in just moments. Hey, Phil, so given that backdrop on rates, am I buying them or am I selling them here? What are we doing?
Rates or stocks?
Stocks.
All right. So our view going into this year is that we would have a barbell-shaped year in terms of S&P 500 performance. We thought we'd get out of the gate in great shape, and clearly we have. Frankly, we've gotten out of the gate in too great a shape. Our full-year target for the S&P 500 is 5,200, and we're essentially there now. We thought there'd be a lot of chop and volatility in the summer associated with the Fed's first rate cut, which we thought would start in July. Typically, stocks go down when the Fed starts cutting, and we think there's going to be a lot of volatility in the summer and fall going into the election. And then we think there's going to be a powerful sort of post-election sigh of relief rally that takes us back to 5,200. So the equity trade here over, say, the next 6 months is going to be one where I think the froth comes off of a lot of the growth in the technology names that have done phenomenally well, over the last 18 months. And I think a lot of the sectors that, frankly, have been left for dead, domestic large cap value, domestic small cap growth, international. I think you're going to see sort of a reversion to the mean, a changing of the guard, if you will. And those stocks, I think, will have a better next couple of quarters than the growth in tech stocks have had over the last 18 months.
So if your call is for the first rate cut coming in July, and you've been hanging with that call for several months now, you must be feeling pretty good right now these days. How about that? I mean, how many people not too long ago were thinking tomorrow is when, the cuts really start rolling?
Well, there's good and bad to that. We were feeling a little nervous at the end of last year and the beginning of this year because we were completely out of sync with the market, and we're sort of scratching our heads, sitting around the table saying, we've got to be missing something. And it turns out that we got this one right, or at least it appears so at this point. Tomorrow's another day, more inflation data, more labor market data, more economic data generally, and this is a game that continues to play out. We come back every day and evaluate, what's going to happen from this point forward.
So, Phil, how about the energy space here? I'm just looking at WTI crude oil moving higher yet again today at over $83 per barrel. How do you guys think about the energy space?
Well, Paul, again, this is one of the things we talked about at the beginning of the year. Energy is an overweight for us. With WTI sitting at $65 at the beginning of the year, our view is that it was mispriced.
Yep.
Particularly given the volatility in the Middle East and the fact that our strategic petroleum reserve is sitting at half. We felt that crude would get into that $80 to $90 a barrel neighborhood by the end of this year, and you said we're now in the low 80s 3 months in. So crude is absolutely moving in the right direction.
Right. All right, Phil, thanks so much for joining us. Always appreciate getting your thoughts there. Phil Orlando, Chief Equity Market Strategist and Head of Client Portfolio Management at Federated Hermes. Right now, we're going down to Houston, Texas. Our good friend Alex Deal from Bloomberg Television. She's speaking with Dow CEO Jim Fitterling. Let's go to that right now.
Paul, good to hear you. I'm glad you're back from vacation. That's right. I'm here with Jim Fitterling, and it's such a pleasure to have you. Thank you so much for joining.
Thank you for having me.
Is this an economy, a U.S. economy, that needs Fed cuts? What's your take on a global scale?
You know, it's starting to feel like the economy is gaining a little bit of strength at the beginning of the year. It's not robust. Maybe a little bit early to tell if this is a long-term trend, but it's been a decent start to the year. Electronics has been a bit stronger than last year. Last year was a kind of a weak spot, so our outlook is good. Automotive had a good year last year, and I think despite the discussion around electric vehicles and some of the flat to negative sentiment that's in the news, the reality is I think it's going to be another good year in the automotive sector. Housing's been the slow start, but there's been an uptick in single-family home starts, which is good. That usually has a ripple effect through a lot of other durable goods manufacturing. We haven't seen that yet. So a modest, good start to the year, and we just see how things develop.
So we're getting there. So that begs the question that if we do, say, get 2 to 3 cuts this year, for example, from the Fed, is your expectation that we see accelerated growth, higher inflation? Like, does that actually start more growth?
Well, I think in the commodity space, and in our industry in particular, we tend to lead into a slowdown. And so we started to lead into this 18 months, middle of this year will be 24 months ago. And we typically tend to lead out. And so it's too early to say we're coming out, but you can start to see shoots that are like when we see a recovery. And of course, that demand, you know, what's missing from the economy right now is the durable goods demand and construction demand. And when that comes back, those are high volume applications, and that demand pool is going to mean that prices are going to move up a bit. I don't know if I would call that necessarily inflationary, but that's just the cycle.
What do you think it's waiting for?
I think it's waiting for rate reductions for the mortgage rates to come down. I think that's the next big thing that typically triggers a kind of a shoot up in the housing market. And then that triggers a lot of other services and durable goods demand that comes behind it.
So we may see a second half recovery.
I'm
That's
hopeful.
Sort of what I'm hearing from you.
I'm hopeful, yeah.
Is it a similar picture over in Europe? So the chemical sector in Europe is under a lot of pressure. I mean, input costs are high. The economy there is weaker in many sense compared to the U.S. What's your take?
European consumer demand is not nearly as strong as it is here in the States. And of course, the weight of higher energy costs has hit the consumer in a lot of different ways. Now we're seeing an improvement year over year. Obviously, energy's come down, but natural gas is below $10 a million BTU landed in Europe. But we sit here today at $1.60, and maybe the long-term trend is $2.50 to $3.50.
Yeah, but still, that's a difference.
Still a big difference. And electricity, you know, which most consumers purchase, electricity costs are double, maybe a little bit more than what they are here in the U.S. So I think, you know, there's a big question. When I look at my downstream customers in Europe, I'm always questioning how long will they be there? And if you don't have a domestic market to service in Europe, you really can't afford to export from Europe. So if you don't have a domestic market to service, you have to say, you know, what does my footprint need to be? How long can I be there in order to be part of that economy?
That's a big deal. I mean, you're talking about the automotive industry, construction industry. Like, is that going to move? What's your best sense?
A lot of technology comes out of there too. I mean, beyond just the industry, a lot of the technology that we use around the world starts in Europe. And so, you know, exporting technology obviously is a little bit easier than exporting product, but we're already starting to see imports of electric vehicles from China into Europe. We're seeing China has become a lower cost competitor than Europe in petrochemicals, so you're starting to see product move into Europe. The Middle East obviously has been a big supplier because of their cost position into Europe. Europe's getting a bit of a reprieve right now because of the Suez Canal.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
We're able to recover some of the higher costs of scrubbing out the CO2 from the price on carbon. And the Alberta government and the federal government in Canada have investment tax credits and incentives for us to put in the hydrogen technology in the first place. So both of those things mean we'll be able to make a return like the project we built down here in Texas. And I think if you look at what we did with IRA, we also made a big step forward. One with the tax credits and the support for new technologies. But I think more importantly, the breadth of the IRA. So we, as opposed to say the EU, which is very focused on a transition, but very specific, you can only make green hydrogen a certain way. We said, look, all forms of low carbon energy are part of the equation, and we're going to make it accessible for everybody to be part of the equation. So that could be small modular nuclear, which we've signed up to with the DOE and the Advanced Reactor Demonstration Program with X-Energy. We're looking at one of our sites here in Texas, Seadrift near Victoria, Texas. And we're looking at that site to basically replace all of our combined cycle gas cogen with a small modular reactor for 80 megawatt units that would take all the power and steam at the site to zero carbon.
Wow.
That's a big project, but we think we can do that and help X Energy bring that cost competitive with hydrogen carbon capture or combined cycle gas with CO2 scrubbing. We think we can be competitive with both of those.
Jim, so great. I love getting that perspective, the global perspective and the energy transition perspective. Thanks so much, Jim Fitterling, CEO of Dow. Paul and Molly, back to you.
All right, thanks very much, Alex. Appreciate that. That's Alex Steele. She was sitting down with Dow CEO Jim Fitterling in Bloomberg's Houston bureau there, just looking at Dow, formerly Dow Chemicals, DOW is the ticker. Stock's about a $40 billion market cap company. Stock's up about 3% year to date, up 19% on a trailing 12-month basis. I was looking at the A&R function for Dow. 4 buys, 22 holds. So the street's kind of waiting on the sidelines, looking for some catalyst there. All right, let's get a little bit of a reset here on these markets, and we can do that with Lisa Mateo.
You got it. And it's a mixed morning on Wall Street right now. We have the Nasdaq down about 0.4%. The Dow is up about 0.3%, but the S&P 500 down about 0.1%. We had some housing data come in. The Commerce Department report shows new home construction advanced in February. This is on the heels of January's sharp drop. Building permits, they also increased, the highest since August, with mortgage rates off recent peaks. We're not done yet. There's more housing data on tap this week. We have existing home sales coming out on Thursday. Over to yields, a 2-year yield at 4.68%. That's down about 4 basis points. A 10-year yield at 4.30%. That's down about 1 basis point. To commodities, where spot gold is lower at $2,154 an ounce. And over to oil, we have Brent crude at $87 a barrel. Currencies, a dollar stronger, Japanese yen weaker. We have the euro, British pound weaker. Bitcoin at 62,900. That is your Bloomberg Business Flash. Paul and Molly.
All right, Lisa Mateo, thank you so much. We appreciate it. Well, it looks like we're going to be able to keep this government open, I guess, through September 30th. U.S. lawmakers reach a deal to fund the government through September 30th. Woohoo!
That's a pretty long deadline for these, or runway, I should say.
For these guys.
I feel like normally, like maybe, okay, we're going to get another 6 weeks, not 6 months.
Yeah, I can't pat these guys on the back.
No, I don't think Laura Davison is cheering for them either, but she's going to tell us more.
All right, Laura Davison joins us, Bloomberg News political reporter. So, Laura, I mean, should we be patting these folks on the back, or just another sigh of relief that we live to fight another day?
You know, why not both? I think that there's a big collective sigh in Washington that a deal has finally been reached. We've been sort of at this, extended another, 2-3 weeks, another 2-3 months for the past several months. So this finally gives folks in Washington some time to focus on something other than, dealing with an impending shutdown in the coming days. So that will help, kind of clear Congress's schedule. Of course, it is an election year, which means that, almost everything that lawmakers do, is with an eye towards November's election.
So this is interesting that we have out in the Bloomberg story that's out on the terminal this morning that these negotiations were reached last night in a quote handshake deal is how we describe it. So the first task is that we actually have to put the deal in writing, and that could take a couple of days. So walk us through this process, and that maybe it's I know Paul's not cheering, but not time to cheer yet.
Yes, so, generally they kind of come together with these high-level deals. I mean, they have it on paper, but then they actually have to have, the lawyers and the legislators sit down and write the technical legislative language. That could be until tomorrow before we actually see that. And Mike Johnson, the House Speaker, has promised his members 72 hours to look at that legislation before a vote. So, of course, he can always, renege on that deal and give them less time to look at it. But this could mean that a vote could spill into the weekend, which, of course, the shutdown would be Friday at midnight. Going into Saturday. So there's the potential for a short, couple-hour shutdown that doesn't really affect anything. Biden has said he will sign this bill immediately. So, I think we'll expect to see a vote come to pass, either, later in the day on Friday or early in the weekend.
So, Laura, is there anything really dramatic about this particular piece of legislation? Did anybody win anything? Anybody lose anything? Anybody really unhappy? I'm thinking about the far-right Republicans, maybe?
Yeah, so the big contentious point, and the reason that this is sort of coming up right on the deadline is was disagreements over DHS. Democrats wanted a little bit more flexibility on how to spend that money, and Republicans wanted more insurance, that there would be, some specific amounts for Border Patrol and other issues. You might recall just a couple of weeks ago, there was a big bipartisan border funding deal that had come together that was, immediately killed by Donald Trump as soon as that came out, and a bunch of Republicans backed away from that. So this has been just sort of the biggest issue, both for sort of the far right Republicans as well as for Democrats who see the potential to get something done, and also know that this is a potential weakness for them going into November's election.
So speaking of November's election, this deal is going to fund us through September 30th. I mean, that's not too far away from when the election is. So, I mean, I think, it sounds like lawmakers on both sides are obviously cognizant of that. Nobody wants to get into a shutdown into an election year, let alone, about a month before the vote. But how do you see that maybe playing out once we come up against that September 30th deadline?
Yeah, so how this is supposed to work is that Congress would pass all 12 funding bills. They'd have the committee hearings, they'd take all these bills to the floor, and then have those all ready to go by October 1. That rarely ever happens. So, there's a couple chances here. We could see, partially, kind of as we have here, there's the government funding is moving in different chunks. So you have some of the budget done, essentially, while you have other parts saying, okay, we'll continue on with a continuing resolution, or what's known in Washington as a CR, which is kind of that kick the can down the road. Let's fund the government at current levels for another couple weeks. So that's probably the most likely scenario, is you'll see some sort of short-term funding deal get past the election. So then lawmakers can have this fight, up against the holidays, which is always a motivating factor to get a deal done, because people want to go home for Thanksgiving and Christmas to see their families.
Yeah, I think we're going to have a conversation. I'm going to guess, I don't know, September 28th with you, Laura. You're going to be on here, and we're going to be talking about, oh boy, we've only got 2 days left to go. I mean, is that how we should think about it again?
I always like to say that Congress is a lot like high school students. You can set the deadline as far out as you want, but they are going to get the deal done, with days or even hours or minutes to spare.
Yeah.
Always a close call with these guys. It just really does. I feel like I have to ask this every time we've got a shutdown conversation, because it really is quite embarrassing. This is the world's most advanced democracy, allegedly, and this always happens. I mean, do you think that there could be maybe some kind of a catalyst, depending on how the election plays out, if there's, a change that who's in the White House and who's controlling Congress is more aligned, that we don't have as many of these in the upcoming 4 years?
I would like to think that might be the case, but that's not been the trend we've seen for the past several years. If we've seen more CRs, we've seen more of these short-term CRs versus, kind of going through the official appropriations process. We are just now, basically 6 months into the year, finally getting a budget deal. This is kind of the way of the world now.
All right, Laura, thank you so much for joining us there. Laura Davison, she covers all that stuff down there in Washington, D.C., politics for Bloomberg News down in D.C. Again, we have that continuing resolution. It takes you through September 30th. So
very close to the election.
Yeah, that's
it makes me nervous. I don't like it.
That's a great point. You're going to be right there at the election trying to negotiate some, keeping this government open. That could get a little bit dicey. S&P 500, pretty much unchanged at the moment. The Dow's up about 0.3%. NASDAQ off about 0.4%. We're going to have more coming up. This is Bloomberg Intelligence. Good morning. All right, looking at the yield space here, we got the 10-year Treasury. It's off about 2 basis points. Let's call it 4.3% on your 10-year, again, before the Fed tomorrow. Commodity space, looking at WTI crude oil moving higher yet again, up 0.7%, $83.29 per barrel. And Bitcoin, it is the big mover in the commodity space, off about 6.5%, just under $63,000 per token. So we got some selling here after a big move higher. This is Bloomberg.
Now, your company news headlines on Bloomberg Radio.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. NVIDIA shares losing some steam after yesterday's big news. Right now, they're down about nearly 2%. The company unveiled a new processor design called Blackwell. It's a little bit faster at handling the models that underpin AI. Max Bloxham at Bloomberg Intelligence has more on the tech.
About 2.5 times more powerful than the Hopper platform that it replaces. So the B100, that's going to be the new terminology to replace the H100. But I think as well as the performance, the CEO is very keen to emphasize the reduced power consumption of this new platform, which obviously every corporate is incredibly sensitive now to their environmental footprint.
NVIDIA is the first chip maker to have a market capitalization of more than $2 trillion. And sticking with tech, shares of Super Microcomputer, they're lower. They're down about 11% right now. This is after offering to sell 2 million shares of common stock in a public offering. Then we have Unilever. It's hoping to sweeten things for investors by cutting the sweets out of its business. Bloomberg's Jess Menton explains.
The company does plan to separate its ice cream business and cut 7,500 jobs as its CEO is seeking to boost profits. It's also trying to jumpstart sluggish growth at the UK consumer goods conglomerate here. So this has come about 9 months since taking charge of basically what's happening with his company. So this is something that investors were watching very closely.
Unilever is up about 3% in London. Moving the markets, Fusion Pharmaceuticals, they're soaring. They're up about 97% right now. This is after news AstraZeneca is going to buy the company for as much as $2.4 billion. AstraZeneca, those ADRs are down just a fraction. And plant-based company Beyond Meat, their shares are down about 10% right now. The company filed a $250 million mixed securities shelf registration. That is your company news at this hour. I'm Lisa Mateo.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, looking at these markets right here, the S&P 500 is pretty much unchanged. A little bit of move higher in the Dow of about 0.4%. The Nasdaq's off about 0.4%. So not a lot of movement in the index level in the marketplace here. Waiting the Federal Reserve tomorrow. We'll have full coverage of that tomorrow. Fed Chairman Jay Powell with the statement at 2 p.m. Wall Street time. Press conference at 2:30. Right now, with our news in New York City, here's Michael Barr.
Thank you, everyone. A former White House advisor to Donald Trump is going to prison. Peter Navarro has to report to a federal correctional facility in South Florida within hours. Navarro was convicted of contempt of Congress for refusing to testify before the House January 6th committee. He insisted his testimony should have been shielded by executive privilege, but a federal judge refused to allow that defense and sentenced Navarro to 4 months in a minimum security prison in Miami. Late yesterday, the Supreme Court turned down Navarro's final appeal. There's a handshake deal in Washington to avert a government shutdown. Congressional leaders and the White House reached the agreement last night, ending 6 months of bitter partisan fighting. Brown University political scientist Wendy Schiller.
I think it's almost 40 years we've been bemoaning the federal deficit. And for 40 years, it just keeps growing and growing. And of course, our national debt is so much larger than it ever has been before. But the economy seems to be pretty vibrant, pretty healthy. And, you know, I think a lot of people are attributing this, particularly in the Republican Party, to the Trump tax cuts, although not publicly, and then COVID.
Brown University's Wendy Schiller was a guest on Bloomberg Daybreak. Defense Secretary Lloyd Austin pledged the United States' continued support for Ukraine in its defense against Russia. Speaking at Ramstein Air Force Base in Germany today, Secretary Austin told the members of the Ukraine Defense Contact Group that over the past 2 years, Russia has paid a staggering cost for President Vladimir Putin's imperial dreams.
Russia has squandered up to $211 billion to equip, deploy, maintain, and sustain its imperial aggression against Ukraine.
Defense Secretary Austin says the U.S. will not let Ukraine fail. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg, Paul.
All right, Michael Barr, thank you so much. Molly Smith is sitting in for Alex Steele. Molly Smith is the editor on the U.S. economy for Bloomberg News, but she is also our go-to correspondent for all things in the world of tennis. All right, so last week was Indian Wells in California, big tournament. Coming up is another big tournament in Miami. What's happening in the world of tennis?
Yeah,
You're going down to Miami.
The Sunshine Double. That's what they call these back-to-back Masters 1000 events. These are two of the bigger ones that are just beneath the Grand Slam level. So yes, I'm very excited. I'll be in Miami from Friday to Sunday.
Nice.
Shout out to my mom. Happy early birthday. That's where we're going. Yeah, it's, I think the latest news on that is that Djokovic, after losing pretty shockingly to somebody ranked outside the top 100 in Indian Wells, he pulled out of Miami. So that now leaves Carlos Alcaraz as the top seed, Jannik Sinner as number 2. Would not be surprised to see those two guys in the final. I mean, they are, without a doubt, playing the best tennis in the world right now on the men's side.
All right, and on the women's side, Swiatek.
There you go.
Got it. She won in Indian Wells, right?
Yes, she's also been pretty unstoppable. I mean, kind of a theme of her Indian Wells matches. Maybe it would be a bit of a contested first set, get to 3-all or 4-all, and then just runs off with the last, 9 or so games to end the match. So she's been dealing out a lot of bagels, as we say. The bakery is open, and Iga looks very, very strong right now.
Okay, so we get through Miami, another big event, and then what's on the Grand Slam calendar first?
The French. So that's actually why Djokovic pulled out of Miami. He is trying to jumpstart his clay court season and just get a bit fitter before we head over to Europe, where we've got a whole bunch of clay court tournaments in the spring. Monte Carlo, Rome, Madrid. Those are the big ones. And then the French starts in late May.
Okay, good stuff.
Then, of course, the Olympics also going to be played at the French Open grounds.
Ah, that's right. Okay, very good.
Exciting.
Forgot about that. We had a lot of tennis going on out there. Again, this week, the men and women are in Miami. Our very own Molly Smith will be there. So if anything's breaking, we'll get that reporting, of course. We'll have more coming up. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, one of the interesting stories today is Unilever separating its ice cream business. I mean, that's a great headline. It just writes itself. I have no idea what's going on there. But we're going to have two smart people help us out here, Deb Aiken and Duncan Fox. They are both analysts, retail, covering for Bloomberg Intelligence. They'll help us break down this deal for this huge European company. Madison Muller is going to join us as well from Bloomberg News. She's a health reporter on how Oprah Winfrey has become weight loss drugs' unofficial spokesperson. So how about that? So all that's coming up here in the next hour. Let's kick things off in this hour with Mr. Charlie Pellet.
Thank you very much indeed. From ice cream to the scoop on Wall Street, stocks trading mixed right now with Dow Industrials up 141, up by about 0.4%. S&P in the red on this Tuesday now, down 5, drop there of 0.1%. We've got NASDAQ lower by 81, drop there of 0.5%. Stocks are falling as traders take some chips off the table ahead of the highly anticipated Fed decision tomorrow that could help shape the outlook for rate cuts this year. Tech shares under pressure. NVIDIA's new chips is seen as mostly baked into prices. Right now, we've got NVIDIA trading lower by 2.4%. 10-year, 4.30%, with a 2-year, 4.69%. Spot gold, little change, down 0.2%, 21.55 the ounce. And West Texas Intermediate crude up 1.1%, 83.62 a barrel. Bitcoin plunging 7%. Bitcoin now with a 62,000 handle. Bitcoin at 62,609. But the big story, Federal Reserve, they are meeting. Wall Street looking ahead to tomorrow afternoon's Fed decision and Chair Jay Powell's news conference. Ethan Devitt is Chief Investment Officer at Moneta Group Investment.
I think there will, of course, be that parsing of words that the Fed uses, and if there's any more negativity in the words, if there's a reference to stickiness of inflation, I think that's going to be more triggering than the actual dot plot itself. Now, where is the risk? Yes, that this momentum algorithm goes wrong all of a sudden, and we do see risk off. We're also seeing this rising oil price right now, whether that's going to start to be a problem for inflation. So I think it's more about the words than the dots right now.
New home construction bounced back sharply last month. Home building stocks lower. Toll Brothers down 0.6%. KB Home down 0.1%. Lennar lower now by 0.6%. Recapping, stocks are mixed. S&P right now down 6, a drop there of 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pelleton, thank you so much. We appreciate that. Molly Smith, she's sitting in for Alex Steele, who's on assignment today. Alex will be back tomorrow. I'm Paul Sweeney. We are live in a Bloomberg Interactive Broker studio. We're streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Radio, Bloomberg Podcast. Either way will get you there, more or less. Now, also in your dashboard, Apple CarPlay. I know Molly doesn't have a car, so Apple CarPlay.
Molly has an apartment.
Molly has an apartment, thank you, and needs some furnishings. Is that the
yeah, that's my next big asset, but maybe a car one day.
Okay, very good.
With CarPlay.
With CarPlay, absolutely, and it's also... so it's good stuff for in everybody's dashboard. It's good. Looking at the markets here, as Charlie was just reporting, kind of a mix, not much going on there. But let's check in with Abigail Doolittle. It is her job to tell us what's going on in these markets because she follows these markets very closely. Abigail, what are you looking at?
So I'm flying blind just a little bit now because of the security issue we were talking
because
about
she won't lick her finger.
I will not lick my
Fingerprint.
finger. So, but I think I have a sense because I've been checking the markets all morning. So
She works here, folks. We can confirm.
Yes.
The S&P 500 down modestly. The NASDAQ 100 down just a little bit more, down 0.6 to 0.7%. And this, of course, has to do with NVIDIA because we're seeing this sell the news moment where they put up this, as expected, Woodstock of AI commentary in terms of the pipeline of new chips. Investors like it. On the other hand, given the fact that the stock is up as much as 96% this year, perhaps they wanted some sort of upside surprise, or it could just be, again, a true sell the news moment. There's so much momentum going into this conference, into earnings, and then to your point, Molly, last hour, we do, of course, have the Fed tomorrow. Will there be any commentary that's going to put a crimp on the style of these big tech stocks?
I mean, this has just been remarkable. If you look at the 2-year yield this year versus the S&P 500, who do you believe right now? You see that the yield is up at approaching 4.7 on the 2-year, was down at 4.2 at the start of the year, and stocks just ripping higher, nowhere else to go.
I believe bonds right now.
I believe bonds as well, but what are the stock traders seeing?
I think that there's...
Is it just NVIDIA?
I think that stock traders may have massive repricing of risk ahead. I think that there has been a lot of blindness around NVIDIA. The NVIDIA rally, everybody's been talking about what could stop this rally, that as in there's an event that's needed. Well, maybe the event that's needed is a big stock, a mega cap stock, a $2 trillion market cap stock doubling on the year, and the year's only, less than 3 months in. So I think that that's a piece of it, maybe too far, too fast, investors reconsidering that. But again, it's going to come down to the Fed. At the end of the day, the Fed giveth and the Fed taketh away. Everybody's been thinking that 2024 would be a year when the Fed giveth of 3 market rate cuts that could start in, this summer. Now, it's less clear if it's going to start in June, and it's also, I think, less clear if it's actually going to be 3 rate cuts. If they don't cut in June, that means September...
July. July's an option.
Okay, so July. So it would be July, September, and then they're super close to the election on one side or the other. Mm-hmm. Is it October or November? I can't get into my...
November and December.
So November, I would say, is off the table also. Yep. I think that they're going to just stay away from that. But to do a rate cut after the election would be a little bit less political. But I think that markets really maybe need to get used to the idea that maybe it's not going to be 3. If they don't start in June... I think that 3 is a lot harder to get to just given the election. So I think that bond traders are warming up to that idea. Stock traders might have a cruel reality ahead.
All right, very much. Abigail Doolittle, thank you very much. We really appreciate it. Abigail Doolittle, she follows all the markets for Bloomberg News. We woke up this morning to a story that I wasn't really aware was a thing. That is that Unilever, the big consumer products company out of Europe, they're really big in ice cream.
I actually, maybe, again, ignore my ignorance, but I had no idea that they owned Ben & Jerry's.
Yes.
That was, I think Vermont when I think Ben & Jerry's.
Exactly.
Do not think, Unilever's based where in Europe?
If you put up the ticker for Unilever and do the PGEO function, that gives you, kind of revenue and profits by division, sure enough, one of their 5 divisions that they disclose financial information is ice cream. In
How
addition to
about that?
home care, beauty and well-being, nutrition, personal care, and ice cream. It's about 13% of revenue, about 8% of operating income. So it's a thing, and they're going to spin that out potentially. So let's see what's happening there. Deb Aiken and Duncan Fox, they're two of our best analysts for Bloomberg Intelligence. They're both based in London, following the consumer side of the world. Duncan, let's start with you. Give us what's going on here with Unilever. Why are they doing this?
I think if you go back 2 years, they thought about it then when they sort of pushed it into 5 divisions, and it was thought that they may sell it off or IPO it. So it's really coming back to the table. I think it was impossible back in 22 because you had food inflation going off the charts. So I don't think anybody would have dared to do anything with it. But it's a business that is very capital intensive. They've got an excellent market share, 20%, so they're a global leader by some way. But it's one that I suppose if you want to refocus Unilever as a whole, it's a low margin business when you look at it against the HPC business. So I can see why they would consider either selling or IPOing the business. It does make sense.
Hey, Deb, so you've been following the retail space for a while. What do you make of all this?
I think we can go back to the big offer that Unilever had, and the way that since then, over the last few years, they've had a couple of CEOs that just haven't done what the market had hoped. There's always been a wonder over whether beauty and personal care actually fitted with food and refreshments. And I think the market probably expects, Duncan and I were just talking, that nutrition would be the next to go actually, but they can't both go at the same time. So it really does make sense because you're left with businesses which quickly, they say end of 2025, so it's typical, a little bit slow churn from Unilever and the way that they operate, but under the new CEO, Heinz Schumacher, combined with Trian's Nelson Peltz on the board, and the way that he turned around P&G, Mondelez and others, that we would expect to see this business return to hopefully the top end of its 3 to 5% organic sales growth and to high teens digit adjusted operating margin, which is where they used to focus until a few years ago, until that inflation came in and until they just couldn't pass it through in developed markets. They do much better in developing.
So, Duncan, talk to us about the ice cream business. Is it a good business?
Well, I think so. I mean, you can't beat a Magnum when you're on the way home. But let's say it is the global leader pretty much in every geography. I think it's only number 2 in Latin America. So they have leadership, and you said it's capital intensive because about half of that global, I think it's about an $87 billion business globally. And half of that is through food service or impulse buying. So that's why you've got to get everything right on the distribution. And on the whole, it looks like Unilever are holding or gaining market share in most of the regions. So they're running it well. But it does come down to innovation and actually that distribution. We've just got to get it right, making sure that we can buy.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
From the UK, and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurize the handle. The gel flows through the reservoir up to the head of the razor, coating the blade, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Forced or took his position as non-exec director on the board. And the fact that he did so well in helping out P&G and Mondelez, the view was that expected change would come about. And so, yeah, we're 9 months in. He started last July. Heinz Schumacher is ex-Campino Friesland. So he has a huge amount of exposure in the foods business. And I think what this does today is says, together they've sat, they've done a real sum of the parts project analysis, looked to see where savings could be made. It's taken a while. So initially, when he gave his October proposal, it didn't seem much different to what was laid out there from the prior CEO, Alan Yo. But today we have the fact that they are, I'd say, taking the bull by the horns. They're changing the recipe for how Unilever will be, and it needs to be that. Because when I look at what's happened on share price, since 2017, Unilever has only returned 2% annually, and that's against 12% at P&G, 11% at Mondelez, and about 16% at L'Oreal. So it's needed a shake-up, and I just feel that Peltz would indeed have been there and really interviewing Hein for the role, and that I believe that he and the board are really working closely together to make change. And the other side of it is on nutrition, which is a slightly bigger business. It's going to be nearer 25% of the business after ice cream is taken out. That more is to be done there, because when we think about nutrition, do we think about Hellmann's? Do we think about Knorr? No, I think of those as food products, but not necessarily nutrition products. So I feel Unilever has a long way to go there, and I'm sure Duncan, as part of the overall food analysis, will be taking a closer look at that division too.
All right, great stuff, guys. Really appreciate you jumping on board here. Deb Aiken and Duncan Fox. They're both retail analysts at Bloomberg Intelligence. They're based in London. On this news here that Unilever, the CEO, he's going to shed the ice cream business, spin that out, presumably. And I noticed Bloomberg's got a story. They're going to do this joint listing in Amsterdam and London for this Anglo-Dutch company. So that was a big deal competitive-wise between those exchanges. Anyway, Unilever, that stock is up about 3% today, so the market likes that news. We're going to have more coming up. The S&P 500 is absolutely unchanged here. This is Bloomberg.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. Almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Drugs. Yeah, so they heard from patients, there were doctors, there were executives from Novo Nordisk and Eli Lilly on the program as well. The majority of the program was sort of centered on patient experiences with these drugs, but it really didn't get into details about the side effects, sort of glossed over them, and the doctor that they had on talking about them said that the side effects were overhyped.
Really? So again, that kind of goes to the editorial integrity of it. I mean, I'm not a journalist, but
Really? Yeah, I mean,
aren't we all journalists in the room?
I guess. I don't know.
There was definitely, I think that it served a purpose, and Oprah is on these drugs. She's had a great experience with them, so she says, and that's sort of what the program was centered around, and really spoke to that positive experience on the drugs.
So what are Oprah's feelings toward Weight Watchers right now? I mean, this, like you said, she has been the face of that company for so many years, and now just like really seems to be doing like, you know, a total 180, and that Weight Watchers would probably be on the losing end of the success of these drugs.
Yeah, and she asked, I mean, Weight Watchers CEO was on this program, and she asked a very pointed question, you know, what is the role and what's the point of Weight Watchers now that we have these medications, which I think is sort of the question that the whole industry has been asking, and the diet industry and analysts and everyone. And, you know, Weight Watchers CEO said that there's still a role for them to play in supporting the community, supporting people's weight loss journeys. But I guess that still sort of remains to be seen, because their stock's not doing too well right now.
I really hesitate to ask this question, but since you reported on it, what is Ozempic face?
Yes, so Ozempic face is another sort of trend that we're seeing happen right now, especially here in New York. People who have rapid weight loss from the weight loss drugs are getting this hollowed out look in their cheeks, which, I mean, it happens with weight loss. It's not just from the drugs, but it's the rapid weight loss that sort of makes it more noticeable. So then they're seeking out plastic surgery clinics, med spas to get Botox or facelifts and sort of help offset those effects.
Add that to the list of all the winners and losers of what comes out of Ozempic. I mean, I mean, the original kind of knock-on effect was like, oh, you know, all the potato chip companies, like maybe not so good for them, and now plastic surgery coming up. So it's just like the hollowing out of your face. You've got the saggy skin there, and
like the extra loose skin. I mean, AbbVie, which makes Botox, has said that this could be a potential, boon for Botox sales going forward. They said that at earnings last quarter. So it's like
I can't keep up.
Yeah.
So on these GLP drugs, where are we in terms of, I know someone who has a prescription, but this person cannot get it filled because there's not enough supply. Where, and it is not me. Where are we?
Also not insured. Right? Mostly?
So that 2 questions.
Yeah.
Where are we on ramping up supply to meet demand? And then secondarily, who pays for this stuff?
Yeah, I mean, the supply problem has been a huge issue, and Novo Nordisk and Eli Lilly are investing billions of dollars to ramp up supply to try to meet demand. But, I've seen in analyst notes, they're like, the demand for these products just seems like it's insatiable. And at this point, they're already coming from behind. So, and all of these investments in production capacity, take a couple of years to come online. So we're sort of just still racing to keep up with it. It's, probably, Lilly said it's probably going to be, not this year that they're able to meet supply, maybe next year. Wow. So we're still trying to ramp up the supply there. And then in terms of paying for it, we have I think 50% of commercial plans cover the drugs for obesity. A third of state health plans through Medicaid cover the drugs. Medicare does not cover weight loss drugs. So it's very patchy still, and a lot of people are paying out of pocket.
I want to come back to Oprah's role in all of this, because I really find it interesting that, like we've been saying, this is still these drugs are relatively in their infancy, and we don't really know a ton of the side effects, at least over the longer term yet. And I just find it kind of amazing that somebody with a reputation like Oprah is, obviously I would think, she's done her research on this to the extent that it's available, but it's kind of amazing to, just be putting herself so behind all of this when so many people really trust her. And I don't know. I think maybe the skeptic in me is just thinking there's got to be some risk to that from her reputational perspective. This could backfire.
Yeah. And I think that's a risk that the companies it's in the back of their minds too. It's so important, and there is such a long history of safety issues with weight loss drugs. Fen-Phen in the 90s was shown to cause heart problems. There was a weight loss drug in the EU that was pulled from the market after it was shown to cause suicide and neurological problems. So there's I think that the bar for safety with these drugs is really high, and that's something to just be really cognizant of.
Let's not forget too, most of these drugs, weren't they also originated to treat diabetes, right? Not weight loss.
Right. And so we know from 20 years of the diabetes drugs being around that they are safe, and they're definitely safer than older drugs, but they're being used so widely now by people who don't necessarily have diabetes or obesity. And so that's sort of the risk, is we don't know what the risks are in patients who, they haven't really been studied or weren't the target population.
What do the companies say about getting these drugs in a pill format or oral format? Because that presumably would be another driver in usage.
Yeah, that's the next big thing, and that's both of, Novo Nordisk and Eli Lilly are working on pills. That's sort of the next exciting thing that people are watching for, and it also could help with supply because pills are a little bit easier to manufacture than the weight loss shots. Could help with the active ingredients as well because it's a little bit different. So that might help from the supply standpoint. It also might make them more accessible, potentially cheaper. So it's a big deal.
How do people decide if you're looking to to be taking one of these drugs, whether it's Zepbound, Wegovy, Ozempic, how do people differentiate between all of these? Or are they kind of roughly looked at fairly equally from a consumer perspective?
So Ozempic and Mounjaro, which is Lilly's sort of version of Ozempic, those are for diabetes. And then Wegovy and Zepbound are the weight loss drugs. Those are for obesity. And so it really depends on insurance coverage most of the time. And the doctors are the ones that are prescribing it. So they've told me, doctors have told me they tend to prescribe the one that insurance will cover. And so it's sort of dependent on that, but.
Interesting, okay.
Otherwise, what could this be, $1,000 a month, right?
Right, $1,000 a month or more.
Is that what it is, really?
Yeah.
And you have to do it.
For the rest of your life.
Yeah, if you want to
really?
If you want to keep the weight off, right?
And that hollow face.
Yes.
And then add
Plastic
Botox.
surgeon.
Exactly.
Oh, boy.
And round it goes. All right,
Crazy.
Madison, thanks so much for joining us. Great reporting there, Madison Muller. She's a Bloomberg News health reporter, and talking about she's got a couple great stories out there, one on the Oprah and the other one on Ozempic face.
I mean, boy,
All angles.
I'm just floored still at like the ripple effect of all of this.
Right. I mean, having these consumer products companies CEOs come on and talk about Ozempic and its impact on their business. I thought that was incredibly silly, but maybe not.
Yeah, and now that you've got this new problem to deal with, that like you look great, you're slimmed down, but now your face is all hollowed out, and I mean, just man, how do you explain that to your friends?
Yeah,
Like,
I don't know, but I am seeing people. Boy, you lost a lot of weight.
oh yeah.
Yeah, I mean it's out there, even with the regular folk. So anyway, S&P absolutely unched on the day. I'll use that term unch because I know Lisa Bromwich does not care
Sharply unched, as we like to say
Exactly.
in eco world.
All right, let's get world and national news with Michael Barr.
Thank you very much, Paul, Molly, and Lisa. Former President Donald Trump says Jewish Democrats hate their religion and Israel. Trump made those comments on a conservative radio talk show as President Biden tries to back away from his public rift with Israeli Prime Minister Benjamin Netanyahu over the war in Gaza. Wendy Schiller is the political science chair at Brown University.
The more Trump speaks, typically, the less well he does among independents and suburban voters, particularly women. So now you're sort of starting to see Trump break loose a little bit, and the campaign has to rein him back in because when he's quiet, and it's just a comparison between Trump and Biden, he's doing pretty well in the polls.
Wendy Schiller of Brown University was a guest on Bloomberg Daybreak. Donald Trump has ruled out Vivek Ramaswamy as his running mate and is instead eyeing the entrepreneur for a cabinet job. According to people familiar with the matter, Trump personally told Ramaswamy he won't be his vice presidential pick, but is considering him for posts, including Homeland Security Secretary. A Democratic state lawmaker in Arizona told her colleagues on the Senate floor that she plans to get an abortion. Eva Birch said doctors determined the pregnancy was not viable.
I don't think people should have to justify their abortions, but I'm choosing to talk about why I made this decision because I want us to be able to have meaningful conversations about the reality of how the work that we do in this body impacts people in the real world.
Eva Birch described how she had a rough journey with fertility, miscarrying many times, and recalled how she got an abortion 2 weeks before Roe v. Wade fell in 2022 due to a non-viable diagnosis of an unwanted pregnancy. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. A turnaround for the S&P 500 index now in the green, up 1 point, little change, 5150 on the S&P. We've got the Dow advancing 215, just above 39,000 right now, 39,006, up by about 0.6%. Tech lower, NASDAQ in the red, down 0.3%. NASDAQ right now, the composite index down 50 points. NASDAQ 100 index down 0.5%. And the Russell 2000 index of small cap shares higher now by just about 0.1%. 10-year 4.30% with a 2-year 4.70%. Spot gold down 0.4%. 21.52 the ounce. West Texas Intermediate crude up 1.1%. 83.60 a barrel on WTI. Federal Reserve's policy meeting underway in Washington, and there's more than the federal funds rate on the table as we hear from Bloomberg's Vinny Del Giudice.
Officials are expected to review the Fed's balance sheet, namely when and how to slow the pace of draining cash from the financial system, a Fed strategy to manage borrowing costs. At the heart of this debate, how much the Fed can shrink its $7.5 trillion portfolio of Treasury bonds and other assets before there's trouble on Wall Street. Trouble like 2019's funding squeeze. Vinny Del Giudice, Bloomberg Radio.
NVIDIA shares moving lower after its new chips were seen as mostly baked into prices. NVIDIA now down by 1.7%. Recapping, stocks higher. S&P up 2 points, now up by about 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pell, thank you so much. We appreciate that. As always, Molly Smith with me here today. Alex Smith will be back tomorrow. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube. So head over to that intro web thing and go youtube.com and search Bloomberg Radio, Bloomberg Podcast. That'll get you where you need to go. All right, let's do a little fintech here, but how about fintech in the commercial real estate business? We can roll in a lot of discussions here. Blake Janover joins us. He's Chief Executive Officer. The company's name, Janover. He joins us from Boca Raton, Florida via Zoom. Blake, thanks so much for joining us here. Let's start out by just explain to us what you guys do at your company, Janover, which is a publicly traded microcap stock on the NASDAQ. JNVR is a ticker.
Yes, that's right. Thank you so much for having me. So in short, we've got a marketplace for commercial mortgages. The same way there's market makers on the NASDAQ that create liquidity for people that are buying and selling stock. We've built a first-party market for people originating multifamily and commercial loans. So we have nearly 10% of the FDIC-insured banks in America on our platform participating. And we have taken billions and billions of dollars of applications from multifamily, commercial real estate, and other owner-operator developers that are looking for senior debt on their property. It's a very fragmented market, so we're creating liquidity there, bringing it all together in one place.
And it looks like you guys listed last summer. Is that correct?
Yes, and it was a heck of a time to
Yeah,
list.
it looks like it. I'm looking at the stock price graph right now. That was kind of still in the aftermath of all of that SVB stuff, concerns about commercial real estate. So tell us how you've been navigating this journey as a public company.
That's a great question. So I think in terms of Warren Buffett's be greedy when others are fearful and fearful when others are greedy, we saw an opportunity to be in a position of strength in a market that was experiencing significant dislocations. It wasn't an easy thing to do to list while banks were collapsing, commercial real estate was a 4-letter word, and maybe fintech was also, us being a fintech in that specific space. But from our perspective, we have an anti-fragile business that benefits from the dislocation in the market because we add so much more value now than we ever have before. So it does feel like the value of our business is a bit disconnected from the stock price. But I suppose that's par for the course. And we're really, really excited about the year ahead and catalysts that lie ahead.
Talk to us about, from your perspective, kind of your exchange. You see kind of the mortgages trade hands here, buyers and sellers. What's your view of the commercial real estate business these days? I know there's lots of different buckets. It's a lot more than just office space, but kind of what's your view?
Yeah, I think that that's a really great point and well said. I think when people talk about commercial real estate, they just kind of they're talking about office, and maybe they're talking about B and C office in urban markets like San Francisco or New York. And I think those specific properties are definitely higher risk. There's certainly a higher risk cohort of multifamily apartment complexes that were purchased over the last 24 months without interest rate caps, maybe with very optimistic buyers that were highly levered. And so these types of assets are going to have real duress. And it's complicated. Most of the market is in, I think, pretty good shape. So people talk about the wall of maturities. In multifamily and commercial, when I say commercial, it means apartments, office, industrial, storage, retail, hospitality. In the context of these are all balloon notes. So no matter what happens, there is a wall of maturities every year. There's a wall of maturities this year and next year and the following year and forever. That's part of how the business works. So most of these properties are fundamentally healthy. They benefited from inflation. The net operating income on these properties improved, and they're going to be able to service their debt. But there is an exposed cohort of the market. I just don't think it's as sensational as it's being maybe presented on some news channels.
Let's talk about the retail component of that. I mean, we've been talking so many years, calling for like the death of the mall. Obviously, that hasn't happened. It's, like you said, with office space, a bit more nuanced than that, and getting into a tier A property versus B and C. And a lot of the retailers being selective about this too. Macy's, which stores they're going to cut, which ones they're going to focus on. So how do you